can do a particular transaction. So many without knowing also they'll be like doing the transaction, whether it is an admissible transaction or not, whether it is a current account or a capital account transaction, we should know. And also impact created in income tax, the taxation which affected with these transactions. Today we have the versatile speakers on these topics, CA Murali Krishna Ji and CA Rajendra Prasad, who will take us throughout the topic for 3 hours. Hope the members will definitely get benefited and clear all your doubts out of this session. Thank you. I request our treasurer, Prasad, to introduce both the speakers.
Good evening, members. CA Murali Krishna Gottipati is a fellow member of Institute of Chartered Accountants of India, ICAI, and the Institute of Company Secretaries of India, ICSI. He has overall more than 15 years of practical experience and practicing in areas of FEMA, FCRA, CA.T, ODI, ECB, and compounding proceedings, FIPB matters, company law matters, NBFC, public issues, takeover courts, private equity matters, conducting due diligence, valuation, and capital market issues, and also presented papers on set about. He is actively engaged in activities of ICAI and ICSI, regular faculty to the professional institutes and corporate government bodies, and under the undertaken training program and presented papers various topics on the above subjects. With these few lines, I'm happy to introduce CA Murali Krishna Gottipati to the August gathering. He is our first session speaker. Next speaker is CA Rajendra Prasad, fondly known as RP in his professional and personal circles, and the founder member of the firm TRP and Co. He is a member of Institute of Chartered Accountants of India and Institute of Cost and Works Accountants of India. He has 15 plus years of qualification experience in both direct and indirect tax laws. He is one of the most distinguished faculty for direct tax, indirect tax laws. He has authored a book on direct tax titled A Comprehensive Approach to Direct Tax Laws, comprising 4 volumes aimed at meeting the requirements of students pursuing premier professional courses like CA, CS, and ICWAI. He was felicitated by the Honorable SLM of the Andhra Pradesh for authoring a book on the direct tax laws at a very young age. Several articles on taxation in leading journals, which included magazines of ICAI, taxman publications, newsletters, journals of IFA, that is International Physical Association. He is a visiting faculty at ICAI and ICWAI, Hyderabad, Vijayawada, and Bangalore. He has addressed 100 plus seminars at South India forums on direct tax, indirect tax laws, covering all the aspects like GAR, POAM, TP provisions, PE, GST audit, GST annual returns, GST impact on the healthcare industry, and etc. In his previous assignment, he was worked as a financial controller for the world's largest tobacco trading company. He was also instrumental in implementing zero-based budget created on activity-based concept in Microsoft, which was incidentally rated as the icon budget. The subtlety of budgets drawn has been immensely admired and adopted within the company. He is currently practicing the profession through the firm TRP and Co. in Hyderabad. His areas of practice included representation before CIT appeals, ITAT, SUSTAT, Settlement Commission on tax matters involving the direct tax and indirect taxes, and GST also. These few lines, I'm introducing CA Taluri Rajendra Prasad to the August gathering. Thank you very much, madam. Thank you very much, sir.
Thank you, sir. I request the speakers to take over the session, sir.
Yeah, good evening all. Thank you, Bharti Garu and other council members who has given the opportunity for us to come up with this a new concept which we thought like, it will bring a lot of value for the fraternity because we are seeing many times where we are seeing many times in terms of
Prasad, Punde to Umesh. Na dalagostadu sir nadi photo vastada.
I think there is some echo, ma'am.
Request all the members please keep their mics on mute.
Okay, sir. No issues, sir. I have solved it.
Yeah, thank you. So what we thought is because presently there is a sea change in terms of the implementation of lot of aspects in terms of what you call enforcement in terms of the various regulations. We thought the members will appreciate in terms of the ever changing laws and its impact on our profession on day-to-day matters. And that too, we have seen a lot, many times, like, the topics which we are selecting is presenting the views from only one law. Whereas today's topic we selected in such a way that on the same matters, we are trying to bring in a reasonable focus on the presentation in terms of the law from the FEMA perspective, as well as the income tax, which will bring a kind of 360-degree profile understanding to the members, and it will enrich the professions in terms of their day-to-day activity. So we are trying to bring in the topic in such a way that initially we put up, like me first present some introduction to the FEMA, could be for 20-25 minutes, I'll give an overview. And later, Mr. RP also will talk about introduction in terms of the income tax law, in the ever-changing law in terms of the MLI, recent MLI introduction and all those things as well. So that first we will set the tone in such a way that members are brought up to a particular level, and thereafter we want to select a few examples. Some of could be around 8 to 10 situations wherein we try to give the presentation in terms of the law from both the angles. And members are free to post the questions where we try to take the questions during the session rather than at the end of the session, so that the members need not to hold the point that this so-and-so question is bothering me. So that we try to ease the process, and also we try to have a dialogue so that to the extent possible, we try to take as many questions as possible. And thereafter, if still any questions are there, we are happy to answer them through email or whatever other mode institute permits that. So with this introduction, I'm trying to bring the introduction to the FEMA. So please hold on for a minute. I'm just trying to share my screen. So I believe the screen is visible. Yeah. So when we try to see,
Yes, sir.
yeah, thank you. So the overall aspects of the FEMA, normally we need to understand the law, the schematic flow of the law is in such a way that as we understand, there is a act that is FEMA. Under that, there is a rules and regulations. And normally, the central government issue a lot of press notes. And also, RBI since 2014, they are compiling the master directions, which are being issued from time to time, and they have been updated. And RBI keep on issuing ever-changing number of circulars, which we call it as APDR series circulars, that is authorized person directive series circulars. Also, RBI come up with the frequently asked questions related compilation, and also whenever there is any case which is not falling under the automatic route, which we talked about it separately, we need to undergo through the concept of special permissions or specific approvals. or we call it as uh, approval route. So whenever a transaction is requiring an outflow of transaction, outflow remittance, basically we need to go through the law and try to understand whether the transaction is permitted under automatic route or approval route. So whenever we come up with the foreign exchange regulations, we need to understand is that how to approach that whether this transaction is permitted in a particular sequence of order or not. Generally, most of the time, even a business person or professionals, we believe that if a transaction is permitted under income tax law, we can undertake the transaction without much going into the other laws. But factually speaking, what we suggest is that whenever there is any foreign exchange regulation related transaction, first of all, we need to understand is that whether this transaction is good in terms of the national interest or not. So if there is any national interest related concerns, we should not undertake the transaction. And whether money laundering kind of screening also we need to do, because most of the time we try to think like, suppose there is any cash payment transaction is there. So whether cash payment is permitted for foreign exchange transaction, that we always try to see. Maybe even 10,000 rupees example may be permitted for domestic transaction where the transaction is happening between two residents and where there is no other limb of foreign exchange regulation is involved. Then there is no problem as far as the limit of under income tax law is permitted. But for FEMA, normally dealing of anything in cash that is other than other a dealer is a violation, though it may be a permitted transaction under other laws. Hence, we need to see that whether the modus operandi itself, whether it is permitted or not. And normally, in February 2018, the government has come up with a new ordinance called BUDSO, that is Banning of Unregulated Deposit Scheme Ordinance. So now, most of the transactions, we need to screen through these unregulated deposit schemes while we undertake any transaction under foreign exchange regulations. Hence, we need to be very cautious under this particular matter. As well, whenever we take up the transaction, then we need to see the exchange control regulation, that is foreign FEMA, basically what we are trying to think about it. Then company laws like corporate law, which normally Companies Act, SEBI, or insurance regulations, all these things also are equally important. Hence, we need to be very cautious while looking at it respect to law as well. Because, like example, if you say lending and borrowing, so under Companies Act, there are a lot of restrictions whereby an Indian resident, be it a company or can lend and borrow. So we need to screen the same transaction under corporate laws. And last but not the least, whether the same transaction is permitted under Income Tax Act or not. But generally, we are trying to see other way around. If income tax is there, yes, everything is taken care. No, that's why only we have to be very cautious. Maybe we have to unlearn what we have been learning till now, and we try to see a new approach where the transaction is screened under one or more of these laws. There could be multiple options are also possible in addition to what we try to see put over here. But in a summary, in a nutshell, we have to be very cautious that under FEMA, whenever we take up whether this transaction is as per the exchange control regulation or not. When we see this act, this law is very simple in terms of sections, rules, and all those things. The only complexity that comes into picture is because of the dynamism that is inbuilt into this particular law, considering the fact that whenever economy changes, foreign exchange regulations keep on change. Like now, of course, there are very minimum notifications that are coming. But earlier, when you see sometime per year, there could be 100 to 150 notifications used to be there, and series of APDR series circulars used to be there. But of course, now after GST and all these laws, similarly, many laws are getting changed. The only thing is what we are trying to see is what we know may be up to date. Hence, we need to revalidate our subject in such a way that whether this transaction is still permitted considering the latest amended law. Hence, we need to be very cautious. And as of now, there are 49 sections, 7 rules, and 27 regulations. I'm not going into every material that I'm trying to give here. Of course, this will be shared to all the participants. So the only is I'm trying to bring in key definitions and key concepts so that at least we'll understand the nuances of the FEMA. Under FEMA, we need to understand that there are two types of transactions. One is capital account transaction, other one is a current account transaction. So capital account transaction is a transaction which alters the asset or liability, including even a contingent liability outside India, in the sense whether the asset might be located outside India or liability might be located outside India, but of a person resident in India, or asset or liability located in India, but it is related to a person resident outside India, or any transaction which are listed under section 6.3. And you may appreciate that section 6.3 has been amended in 2014 through Finance Act 2014. And it has been implemented only in October 2019. So until almost 5 years, this 6.3 has not been modified. But now, most of the regulations under capital account transaction as well are shifted to the central government, because a new section, that is section 6.2a, has been inserted, and through which now every power except regulation related to deposits or borrowings, except that all other items, now they are under the purview of the central government. Till now, the central government has issued only one particular rule, which I just try to put it here, that is FEMA non-debt instrument rules 2019, after this particular amendment. Prior to that, RBI used to issue the circulars or notifications, etc., under the previous law. So this is what is the latest change or major change. Hence, we need to be cautious, because the foreign direct investment we used to read until 2019 through a regulation, that is up to 14th October 2019. But on 14th October 2019, the central government has issued new rules called FEMA non-debt instrument rules, which are clubbing or consolidating the FDI regulations as well as immovable property regulations. So that's why we must be aware of this particular thing. And the another important thing is, what is a current account transaction? So all current account transaction, normally what we know is a transaction which is not a capital account transaction, and any payment related to foreign trade, current business, services, short-term banking, etc., which fairly is a business-related transaction. And some of the personal remittances related to living expenses of parents, spouse, children, etc., who are residing abroad, or any foreign remittance related to foreign travel, education, medical care of parents or himself or herself, their spouse, children, etc. These are normally are called current account transactions, because under FEMA, all current account transactions are freely permitted unless they are specifically restricted or prohibited. Whereas in case of current account transactions, in case of capital account transactions, all capital account transactions are prohibited unless they are specifically permitted. So the dimensions are: current account transactions, predominantly they are permitted unless they are restricted or prohibited. Whereas in case of capital account transaction, all capital account transactions are prohibited unless they are specifically permitted. So this is the approach we should have. Other definitions, maybe you can take it later. So another important thing is the person, because normally under Income Tax Act also there is a definition called person. Practically, this is almost a replica of it, except in case sometime even a small office or a representative office or a branch also will be considered as a separate person under FEMA. Whereas for income tax, sometimes we don't see it as a separate person. And currency, it includes everything, which normally we are aware of. And to understand when the foreign exchange regulations are applicable, we need to understand, sorry, the definition of person resident in India. Under income tax law, normally we know a person who is in India for at least 183, 182 days or more will be normally considered as person resident in India. Of course, subject to other things in terms of the resident but not ordinarily resident, resident and not ordinary resident, person resident in India, whatsoever it is. But for foreign exchange regulations, not only the period of stay is important, even the purpose of stay is also equally important. So if a person is residing in India, but who has come for the purpose other than employment or carrying on business in India or for a very long term purpose, but if he has come for the sake of say travel and he is in India even for 364 days due to whatever reason it may be, but still he is not considered person resident in India, because as per the FEMA, the important thing is the person who might have come to India must be, yeah, sorry, 1 minute, yeah, might have come for any purpose other than employment, carrying business, or for a long-term purpose. His stay in India cannot be considered for residential status calculation. Whereas a person who has been in India even for say 364 days, but if he is leaving India either for taking up employment or carrying on business or for a long-term permanent residence or a long-term visa he might have holding, in those cases, if he is going out of India, from that day onwards, he is considered as a person resident outside India, though he might be in India in the last year, maybe more than 182 days. So that's why one is the purpose of travel or purpose of stay is important apart from the number of days that the person is in India. Okay, or even sometimes if a resident in India travel abroad for the purpose of the tourism or for a short visit, but he might have been detained outside or he has been retained because of his health condition or like a lockdown what we have seen for anything. But if he has been, he is not staying out of India voluntarily, but for very restricted purposes, then even if he is out of India for more than 182 days, still he can be called a resident in India, because the person has not gone out of India either for employment, business, or for long-term stay. So that's why we have to be cautious, because we need to take the number of days of stay as well as the visa copy also to understand what is the purpose of his absence or presence in India. And any person, I mean any company which is registered in India, irrespective of its ownership, is always a person resident in India. Even say 100% is owned by a foreign entity, still irrespective of that control, the company is called person resident in India. And any branch office is a person resident in India. Branch office means office of a foreign entity is a person resident in India. Equally, an Indian entity, office or a branch which is located outside India is a person resident in India. Like that, we need to understand even the foreign branch of an Indian entity has to follow all the Indian regulations in terms of the forex regulations. So that's why just because a particular law doesn't specify a specific process like dealing in cash outside India may be an offense if the transaction is handled by a branch office of an Indian entity, because they need to follow foreign exchange regulations of Indian laws. So we have to be very cautious in all these things. And another important, whenever we take up a forex regulations, most of the time we see the word NRI, non-resident Indian, or person of Indian origin. So this is very loosely used in a day-to-day practice. But the word NRI means only a person who is citizen of India but resident of a foreign country. It means he is not holding any other country's passport or citizenship. So he must be an Indian citizen and staying abroad. And in case of PAO, which is now normally we call it as OCA or Overseas Citizen of India, If the person is a person of Indian origin, in terms of whether he was holding Indian passport, which might have been surrendered while he is taking Indian, any other country's citizenship, or he or his parents or grandparents were born in India, could be 55 before 1955 or whatsoever, or even thereafter as well. A person who is a spouse of an Indian citizen, or a person referred in clause A or B above, even that person is called PAO. Because this is very important definition, because some of the regulations, they give a lot of leverage or a lot of liberty to undertake transactions in India. Hence, this definition of NRI or PAO is very important, and it cannot be liberally used. So we must be cautious on this aspect. So FEMA will come into picture whenever a transaction is taking place between a resident and a non-resident, or the currency used is a foreign exchange, or if two non-residents are dealing in INR, or if the asset or liability is located outside India, but it is dealt between two residents, or an asset or liability is located in India and it is dealt between two non-residents, or one leg is resident, other one is non-resident. It means there is every possibility that remotely there could be a FEMA transaction considering either the asset or liability or a status of the residency or non-residency, and whether they are dealing in Indian currency or foreign currency. So these are equally important while we say that whether FEMA is applicable in a particular transaction or not. So we must be very cautious. And we have given the rules here, the 7 rules and the regulations. Maybe I'll not go into detail, but most of the cases, the transaction may fall into any one of these many rules or regulations. So just because we have read one particular rule or regulation, we cannot say that the transaction is fairly permitted or whatsoever transaction that we try to see. And the latest regulation that has come into picture is in October, the RBI has issued margin for derivative contracts regulations. This is the latest one. And we sometimes the margin, if we are trying to pay, that also is very important over here. With this brief introduction, I believe we can take up the discussion of Mr. RP, who will present some inputs on the similar transactions under the income tax law, and thereafter we try to bring in a connected discussion of a selected items from both laws. Dear RP, I think you can take over.
Yeah. Thank you, Murali sir, for summarizing the FEMA and lucidly explaining what are the triggering points. Okay. So, friends, I also many a times the clients also ask that, sir, we are remitting an amount to the non-resident and the TDS rate is 10%, treaty rate is something. So, will it be okay if we comply with the same? Then of late we started advising. Of course, we started advising. Of late they also started realizing that. So they need to focus not only from the IT perspective, but also from FEMA perspective. Particularly in the context that there are lot many changes, new regulations are coming from both RBI as well as ministry as well. So, because recently I have seen several cases where they have approached us for compounding of the orders also, because they felt that once they comply with the income tax regulations, that is all, but it is not. Income Tax Act, of course, it is a part of one legislation. You need to comply with others as well. Okay. So let me briefly walk you through some of the basic provisions of the section 195. Then after that, we will discuss on the same point what are the regulation from income tax perspective. Then what precautions you need to take from FEMA perspective. Murali sir will throw some light on the same. So first I will be giving some basics about 195 because today's topic is only compliance in relation to non-residents. remittances to non-residents. After that, we will be walking you through what are the compliances in relation to the capital gains, because we will discuss the ones which are more relevant for most of us. Like our clients will sell immovable property here, and he is settled outside India. He left to USA for having a job there, and now after some time he want to sell a property at Hyderabad or Vizag, whatever property. Then after that he wants to repatriate the money to USA. So what compliances we need to take? Of course, all of us may know, but let us understand from 360 degrees perspective what we need to take care under the IT Act and what are the precautions we have to ensure under the FEMA. After that, the most prominent will be royalty, fee for technical services, then dividends, of course, after amendment particularly. Then the cases are, I don't have PAN number, I don't have TAN number, those are the cases. And recent introduction is MLI, multilateral instruments, so which treaties got amended on account of the MLIs. So those things I will walk you through. And after that, I have some special cases, detailed thing also. If the time permits, I will present those things also. And because we want to give more time for the audience also, so that any issues, specific issues, we can have more discussion, because I will be sharing the detailed presentation also to the Vizag branch after this is over, where I have given case law backup for each and every the view which has been taken here. Okay. So with that, let me just give me a second. I will share the screen. Yeah. Madam, the screen is visible, madam? Yeah.
Visible, sir.
Right, madam. Yeah. So tax implications under 195. Okay. See, okay, as Murali sir rightly told, first 20 minutes I'll be explaining only the basics. Kindly bear with me. You may be knowing all these things, but nothing wrong in once again doing a revision or recap. As simple as that. See, 195 when it is triggered, whenever you are making any payment to a non-resident. In simple terms, it is like that. But remember, whenever you are making any payment which is chargeable to tax in India, then section 195 is triggered. Okay. So what are the types of payments? Certain types of interest, certain types of other sums, other than the cases where they are already covered under some other sections. In simple terms, salaries, it is already covered under 192. You are making a payment to a non-resident employee, TDS is required to be deducted under 192, because 192 covers, it can be a remittance to a resident or non-resident employee. So 195, if you see the chapter heading or the title heading of 195, it reads as other sums. What do you mean by other sums? Whenever you are making any remittance to the non-resident which is chargeable to tax in India, and it is not covered under a specific section like 192, like 194B, 194, sorry, LB, LC, LD, etc. Those cases, 195 will be triggered. Okay, 195 is in a sense omnibus section. Like if there is no specific section with regard to the non-resident payments, non-resident remittances, then 195 is triggered. Right. Then we need to remember that the scope of 195 is very, very wide. So what do you mean by wide in that perspective? Reason is very simple. All types of pairs are covered. If you see 194C, 194H, 194J, 194I, all these are having some relaxations. Like individual, you are an individual, you are making a payment of rent. Of course, I am not talking about the new sections. So normal rent, when you are making payment and you are not a tax audit assessee in the earlier year, then there is no requirement for you to deduct TDS under 194 regular series, sums to residents. But 195 is not like that. 195, it doesn't have any threshold exemption. All types of deductors are covered and no exemption, no threshold exemption is there under 195. You are an individual, you are covered. You are a HUF, you are covered. you are not a tax audit assessee, you are covered. The moment you are making a payment to the non-resident and that payment is chargeable to tax in India, then that is liable for TDS under 195, right? So just morning one person asked me, sir, one non-resident is making payment to another non-resident. One non-resident is making payment to another non-resident, but that sum is taxable or chargeable to tax in India. Whether TDS provisions are attracted or not, definitely yes. Definitely yes. You can refer this Linklaters case is there. It is a popular case. Okay. Of course, this amendment is on account of the Vodafone fallout. Earlier also the view is same, but after Vodafone judgment, they have further added some explanation whereby it is clarified that any payer is making to any pay, any non-resident pay, but the sum is chargeable to tax in India, then TDS is attracted under 195. As simple as that. Now the next question is, many people will pound on me saying that, sir, how you can come to that, sir, that conclusion, and how the Indian government will have a radar on that one. See, that is not our cup of tea. But remember, definitely, after so many agreements, like information exchange agreements, the Indian government is getting lots of data whereby they started issuing notices. I am telling you, I handled 3 cases where they came to me and they told actually they were outside India and they made payment to another non-resident outside India, but that is in relation to a taxable sum in India. I told them yes, but in that case the practical challenges would be both are non-residents, getting a TAN number would be difficult. TAN, okay. Then in such case they need to identify one agent in India. Then they have to give a specific power of attorney, the TAN number on his name. They will do the remittances. They will deduct the TDS. After that, ETDS return they will file. After that, that's it. Close. Okay. As simple as that. So the moot point which I want to drive is when one non-resident is making to another non-resident is also, then also TDS under 195 is covered. But the only thing what we need to remember is it should be chargeable to tax in India. Okay. Right. So what is the time? Of course, at the earliest of generally credit or payment, whichever is earlier. Some cases, very few cases, payment driven. Okay, I'm not spending much time over here. Time for remittance, rule 30, you can see this one. Okay, so rule 30 gives, sir, after deducting what is the time limit by which I need to remit. So rule 30 talks about the time limits. Okay, the next basic question is, okay, sir, I have not deducted TDS. What will happen? Okay, so if you are not deducted TDS, what happens? So first it will be disallowed under 48 clause 1. Then you will be treated as assay in default. Once you are treated as assay in default, then the tax, the TDS component will be recovered from you. Apart from that, interest will be attracted. It depends at the rate of 1% or 1.5%, depending upon whether you are deducted but not paid, or whether you are not deducted at all. Okay. Then there are relaxations also, I'm not talking about them. Then there is a penalty also. Penalty can be either triggered under 221 or 271C. So 221 means a assessing officer will initiate proceedings, whereas 271C means only the joint commissioner has the authority to levy the penalty. Okay. Then prosecution also 276 would be. Okay, these are the things where you are not deducted the TDS, right? Then so far what we understood is there should be a chargeable sum. So there is a chargeable sum to tax in India. Then the pay is a non-resident. In those cases, TDS is attracted under 195. If it is not covered under any other specific section, right? So at what rate I have to do the TDS under 195? Remember, most of the cases we use 195 as withholding taxes. So 195, 192, both are withholding taxes in the sense that whenever the tax liability is equivalent to the TDS rate, it will become withholding taxes. So 195 is a withholding tax. In the case of non-residents, what we have to do is we have to check what is the tax liability of the particular transaction. Then the total tax liability is to be deducted. So you need to apply the appropriate surcharge, appropriate HEC, everything. Then you compare that with the treaty, then whichever is a lower, you examine whether he is eligible to take the treaty benefit or not, etc. So those rates you need to apply first. So first you need to determine the tax liability. The same tax liability is to be withheld as a TDS. Then, sir, the DTI rates contain a beneficial rate. Can I take? Definitely yes. But generally you need to obtain the TRC. Okay. You need to get a PAN number also, but there are certain cases. If PAN is not there, you know that the 206 AA will come into picture. But at the same time, there is a relaxation provision also. That is Rule 37 BC. Recently it got amended. So Rule 37 BC says that, okay, even if you are not having PAN number, with regard to very few sums, interest, royalty, fee for technical services, capital gains. With regard to these four sums, even if the person is not having a PAN number, you can still opt for the treaty rate. Treaty rate. But the only thing is, recently it got extended. But TRC and a tax identification number. Tax identification number is an equivalent to a PAN number over there. So those if you have given these without PAN also, you can go for the beneficial rate. 206 AA is not attracted, provided you give the basic details. And this relaxation is available only with regard to very few sums: interest, royalty, fee for technical services, capital gains, now dividends also. Then at what rate? Rates in force are specified in the Act. Generally, this at these rates, you will do the TDS. But there are very few cases where 94A provisions are attracted in your remittances. Of course, 94A, as of now, as of today, there is no country or no territory which has been notified under 94A. Earlier, they notified Cyprus, and now they denotified also. They withdrawn that notification also. So when you are making any payment to an entity in Cyprus those days, it means it was valid only for under 94A. They notified Cyprus because they are not cooperated, because Indian government has given them a mandate saying that many of Indian entrepreneurs, especially of course Andhra and Telangana entrepreneurs, they have parked their funds in entities located in Cyprus. So we want those details. When the government has given, the Cyprus government has not cooperated. That's why Government of India denotified Cyprus under 94A, notified under 94A, notified jurisdictional area. So the problem, once you are notified under 94A, is then every payment is subjected to a minimum TDS of 30%. That is one danger thing. Reason I am telling you is very simple, because one of the remittances, when one client approached us and we asked which country, Cyprus, then we told them this is the implication that particular year, 2018. So then he told, sir, when this got amended? Yeah, this is amended, and the biggest problem is it is treated as a deemed associated entity. So even though the Indian entity and the party outside India are nowhere related, it is treated as a deemed associated parties, and TP provisions will also be applicable. Imagine TP provisions. We would have never applied, we would have never filed 3CEB report, etc. This person said that, sir, I have pure domestic transactions. But I asked him, you have remitted one time to Cyprus because your 15 CB says so. Being a tax auditor, I need to examine. Then you are supposed to maintain the TP documentation also. Then okay, that is a different story. As of today, 94A, under 94A, no country is notified. Then 206 AA, if you are caught under the vice of 206 AA, then a minimum TDS of 20% will be attracted. Then I just told you there are certain relaxations with regard to 206 AA. Those relaxations are given here. Okay. So with regard to interest, royalty, fee for technical service, and capital asset, So 206AA is not attracted if you are given these details. Okay, sorry. And now it is extended to dividends also. Recently, with effect from August 2020, 11th August 2020, this is extended to dividend also. Okay. So then let me explain for another 5 minutes the basics only. The basic questions which we get is, even though it is written as special issues, but this is a basic issue, right? Sir, the question here is, I need to make a payment of $10,000. I am signing the 15 CB. Okay, $10,000. At the time of signing the 15 CB, the exchange rate is 60 rupees a dollar. So 10,000 into 60. On 6 lakh rupees, the client would have deducted TDS. Then at the time of real payment, the exchange rate jumped to 65 rupees. Now the question here is, sir, whether I need to deduct TDS again on the 5 rupees, the forex fluctuations? The answer is clearly no. I'm telling you, see, don't worry about the case laws, etc. But I've given for the benefit of the members so that they'll get confidence. Okay, whatever statement I'm making, these statements are out of the judgments only. So, see, why that logic we need to apply? So, why it is not attracted in the case of foreign exchange fluctuations? The answer is very simple. The answer is TDS is a one-time event. It says that at the time of credit or payment, whichever is earlier, that's it. One time you have deducted TDS, they are not concerned with the subsequent happenings. Subsequently, because of foreign exchange fluctuation, if the liability is going up or going down, you need not worry at all. So, on that basis, in Sandvik Asia's case, the Pune Tribunal has given a judgment saying that don't worry, on forex fluctuations, TDS is not attracted. Then the next issue is, sir, can I deduct TDS at a lower rate? Yes, there are two models available. One is a payer model, 195.2 model. One is payee model, 195.3 model. So what do you mean by payer and payee model? Under 195.2, payer, it means suppose you are making, your client is making, or my client is making a payment to non-resident. The client will approach the income tax department in ask. Generally under 195.2 will be invoked in the cases where there are composite payments and we are unclear about the component which is liable for TDS. I will explain further more at the time of explain the special issues. I will touch upon one aspect with regard to capital gains. With regard to capital gains, I will dwell upon once again, because the doubt is whether I need to deduct TDS on the gross consideration, net consideration, or indexed cost of acquisition. Other than I have to do all those things. I will explain. I will touch upon those issues also. So the payer can approach the department and he can get a lower TDS certificate, or the payee, it means the non-resident, can approach the department and he can get a certificate. So that is also possible. Okay. So then, okay, this special issues. Okay, surcharge and education, sir, HEC with regard to TDS. Sir, I am affecting TDS based on the rate given the DTIR. For example, in Netherlands TTPC Article 12, that is fee for technical services royalty, the rate given there is 10%. Sir, I am making a payment to non-resident. So I need to make some royalty or fee for technical service to non-resident. Under the IT Act, the rate is given under 115A. 115A talks about 10%. DTI also talks about 10%. Then which one I need to apply? Sir, if you want to take the treaty benefit, you have a TRC, yes, then you take the treaty benefit. If you apply under the Income Tax Act, what happens is you need to apply the HEC also. But when you are doing at the rate given in the treaty, you need not apply HEC on that one, because the treaty talks about the tax liability will be determined at the rate determined as at the rate of 10%, like that. It means the final tax liability should be 10%. Should be that amount which is affected if you have applied 10%. That is the reason. But in the case of income tax, it says that 10% is the base rate. On that, surcharge will be there if applicable, and HEC will be there if applicable. That's why when both the rates are equal and you have TRC, then better to go for DTI rate. Even though 115A is 10% and DTI also 10% is, then better to go for DTIA. Reason is very simple. There is no HSA concept, right? You are not deducted TDS. Then can the AO recover from the non-resident, the whatever you are not deducted? Definitely yes. Okay. Then the next one is gross and net. I will cover that a little later. Okay. So with this, these are some of the basics. I'll hand over to Murali sir. So once he explains after some points, then we will touch upon item by item. Like one of the item which we'll take up is capital gains. Second item is reimbursements. I will explain, and royalty fee for technical service, dividend, how to go about it. PANT, as I just explained, it doesn't have any link with the FEMA. Okay, and after some time, I will be introducing the MLI, how to see the MLI, what are the treaties which were impacted by MLI. I have given a list as of today, it means 3 days back it is prepared. So by PVSS sir, the same thing I will share with you. Okay, over to Murali sir.
Yeah, RP. Yeah, what we can propose is maybe the cases whatever you take in sequence. You please present the views under the income tax law.
Okay.
The same point I'll try to add on from the foreign exchange law so that the flow will go on.
Oh, okay.
Both your presentation we can take about.
Oh, great. Yeah. Right. So yeah, I'll be covering one by one point, and whenever it is a FEMA implication, definitely we'll touch upon that one. Okay. Now let us take this one. Now the first issue here itself is here itself I will explain the capital gains issue also. So issue number 6. Okay. So whether the TDS is required on the gross amount of remittance or net amount of remittance. Okay, what do you mean by gross, what do you mean by net, etc. Let us understand this particular point in detail. Okay. So there is a non-resident. Okay. What he has done is he is basically a person of Indian origin. So he is from Hyderabad or he is from Vizag. He got a job in USA. Now he went and he got settled over there. Now he is selling his property in Vizag. Now the sale consideration is say 1 crore rupees. He purchased this property for 20 lakh rupees 15 years back or 10 years back. Assume that for simplicity, the sale consideration is 1 crore rupees. Indexed cost of acquisition is 25 lakhs. I am repeating the facts, okay, because we are going to spend time on this one. The sale consideration is 1 crore rupees and the indexed cost of acquisition is 25 lakhs. Now, whether TDS is required to be affected on 1 crore rupees or it is to be done on 75 lakhs. Okay. Remember here, see, definitely there can be divergent views, but I am giving the more rational, logical, and considered view. Okay. So that is the reason why I am telling you. So remember section 195 subsection 1, if you see, it says that some chargeable to tax in India. Some chargeable to tax in India. What do you mean by chargeable? Chargeable to tax is not the entire amount. What is the amount which is liable to tax, which is chargeable to? So 1 crore is the gross consideration minus indexed cost of acquisition 25 lakhs. So the 75 lakhs is only the profit element. On that 75 lakhs, we have to deduct the TDS. Number 1. Sir, what will happen if I have done on 1 crore? Nothing wrong. You will get a refund. But why you are taking that conservative view when the Act itself says that, when the Act itself uses in clear terms some chargeable under the IT Act, right? I'll explain with the background with the help of a case law. Okay. See, in Samsung Electronics case, the Karnataka High Court judgment, first what it has done is, it has given a very, very wide interpretation to the word some chargeable to tax in India. What it has done is, some chargeable means everything. So any amount, any payment, whatever is being paid to the non-resident, it is liable to tax in India. Like that, they have taken a very wide interpretation. Immediately the matter went to the Supreme Court. Fortunately, Supreme Court within 4 or 5 months, normally takes more time. But in that particular judgment, you see this Samsung case. Within 4 or 5 months, the Supreme Court stepped in and said, no, this interpretation is wrong. Okay, so the section uses the language sum chargeable to tax. Chargeable element is important. So only the TDS is attracted on the profit component or taxable component. So that's why TDS is attracted only on the taxable sum. So on the net amount only 1 crore minus 25 lakh. The next question, many people say that, sir, I will put some bills, cost of improvement like furniture bills, all the things. Remember, when we are issuing a 15C, when you are issuing a 15C or 15CB, those things which can be documented, which are evidenced by documents, adequate document, and which won't be debated, which the assessing officer or anyone, a rational human being can accept with a naked eye, those things you consider. Remaining thing, if the client says that, sir, I put 10 lakhs for interior, etc., that may be true. In that cases, 25 lakhs indexed cost of acquisition, fine. 10 lakhs if he has gone for improvement, ask him for a real bill. If it is not there, then you explain to him, saying that, sir, I will deduct on 75 lakhs. If you want the remaining amount, you go and get as a refund. Or the other way is, you need to approach the assessing officer. Assessing officer, you prove to the assessing officer, sir, 25 lakhs is indexed cost of acquisition and 10 lakhs is the other amount, indexed cost of improvement, etc. Those things, then assessing officer will certify that amount can be, on that amount you can deduct the TDS. So I repeat, the conclusion, rational or the logical view would be, so on the net amount it will be attracted, number one, the first point. The second thing is, but when you are considering the net amount, remember that you should not do, so you should not give benefit to the assessee like without any background, without any backup. Like he should have the bills, back-to-back bills, etc. Then the next question is, sir, I am making a payment of royalty to the other person. Then you are saying whether I need to deduct a TDS from the entire amount. See, royalty case, the royalty amount itself is liable for gross taxation. Gross in the sense that you may argue that, sir, in royalty, I am making $10,000 to that person. And in that $8,000 is the cost. So $2,000 is only liable for TDS because the section uses the word sum chargeable. No, don't take that view. In the case of royalty, in the case of FEMA technical services, the act itself says that under 115A, if you see 115A, the royalty, FEMA technical service, interest, these amounts are liable for gross basis of taxation. Gross basis of taxation means the total amount 10%. That's why the tax rate is concessional. Tax rate is concessional. So that is the point which I want to explain it to you. Now we will learn something from Murali sir. Sir, Murali sir, we have few doubts, sir, because many of the clients in Hyderabad also asked.
Yes,
the person settled in USA. Earlier he was a resident in India. Now they are asking for a 15 CB. Just I will, okay, after you explain, I will explain the 15 CB point also. Anyway, I will explain that point. After that, we can take also. So, if they are asking, can they remit directly the amount without any RBI approval? That is the first question, sir. The second thing, he acquired property while he was a non-resident. He is selling. Can he remit those sums or not? These are the can you please throw some light on these two aspects, sir? Other aspects also, sir.
Sure. Yeah. So I think I'll also share my screen. Please hold on for a moment.
Yeah. Yeah. Meanwhile, I'll just add one point, sir. Here. Okay. Meanwhile, if we add. Before Murali sir adds, so 15 CB many a times the banker insists that the money is the fund is created to NRE account, from NRE account, sorry, NRO account, from NRO to NRE also the banker is asking, then you can give, but what you need to ensure is, you have to ensure that that should be already a taxed sum, charged to tax in India, then you can give. Okay. Yes, sir. Over to Murali, sir.
So there is one question in the chat box, sir. Would you like to answer it now?
Yeah, please. Yeah, I think is it related to me?
Ours is a social organization in India. We have members in so many countries. They have to pay international dues every year as member subscription of $5 per year. Can they pay without FCRA?
Okay. So it is related to FCRA. Okay. Before I proceed to the other point, okay, let me address this. So basically, under FCRA, whenever somebody is taking the contribution or a donation, then we need to go for the FCRA approval. In the sense, if somebody give any donation or a gift or in-kind gift whatsoever, then the organization which is receiving that amount should have FCRA either regular approval, regular registration, or they should have a prior permission. But in case it is a pure membership fee without being considered as a donation, then obviously there is no such requirement to have this. But the question normally comes is why a person is becoming a member to a charitable trust or organization without being considered as a donation. But if it is a fees or a membership fee related to any particular program, then normally we consider it as a current account transaction under the FEMA, but not under FCRA. So if it is not a membership in a strict form in terms of the any particular product or a project, then normally we consider as a donation. So if it falls under donation, then the organization shall have either a permanent registration or the specific approval, which we call it as a prior permission. Irrespective of the amount, even $5, but when we accumulate it to multiple, obviously it may become $1 million. We don't know, depending upon the nature of organization. So here under FCRA, there is no threshold limit. The only thing is whether is it a donation or a gift or a contribution. But one important thing is under FCRA, the word called as foreign source need to be understood. The word foreign source means the donor or the remitter must be either a foreign entity or a non-resident or a foreign citizen. Then only the Foreign Contribution Act will be applicable. But if the remitter or the payer happen to be a Indian citizen and he is residing abroad, then the concept of FCRA will not be applicable because the word foreign source excludes Indian citizens residing abroad. And another important thing is under FCRA, the word foreign contribution means any currency. In the sense, even if the person is paying in INR or is paying in foreign currency, but in any case, it's a foreign contribution. So here, the two important aspects we need to understand is whether he is a foreign citizen or a foreign entity. And if suppose these are not the case and it happens to be an Indian citizen, then even he may pay in foreign currency as well. It is not a foreign contribution. So unless it is a foreign contribution, we need not worry under FCRA and we can go ahead and accept the amount. So I believe the question is clear. If still some clarification is required, of course we will take it up. Yeah. So coming back to the topic, coming back to the topic in terms of the remittance of the capital gain or remittance of the gifts from relatives or remittance of the even donations from some of the organizations. Please remember under FEMA, there is something called liberalized remittance scheme which now it is becoming popular because of the TCS also is applicable from, I believe, 1/10/2020, the date that is notified, where if the resident is remitting the money under the liberalized remittance scheme, there is a concept of TCS. And now coming back to the concept of remittance by the resident to the non-resident, if the asset happened to be acquired in two forms, because generally the asset could have been acquired, one is by acquisition or as a gift or by virtue of an inheritance. If it happens to be acquisition or a gift, we need to see that the mode of purchase. Suppose if it is acquired through a non-resident's remittances in foreign currency, and the asset happened to be either a residential house or it's a commercial property, or it happened to be an agricultural land or a farmhouse or plantation land. We need to be very cautious because under FEMA, no non-resident can remit the money out of sale related to asset which is in the nature of the agricultural land, farmland and plantation land. Farmland means farmhouse. So if these three kind of properties are acquired, either while he is a resident or he is a non-resident, or even it is gifted to him, even by resident or a non-resident, means one non-resident is receiving gift from another non-resident. Even then, the net of the sale consideration after tax cannot be remitted out of India without RBI approval. And please remember, normally RBI doesn't give approval because these three assets, RBI has kept it in banned category. So any capital gain or any sale proceeds, if they are being remitted by non-resident, who is we call it as NRI or OCI or overseas citizen of India normally, basically the sale proceeds of these three specific assets, that is agricultural land, farmhouse and plantation land, cannot be remitted. Even they cannot be created to his NRE account in India, but they can be created only to NRO account in India. Means the NRI who might have opened an NRO account, the proceeds can be remitted there, but not to NRE account, or it cannot be remitted to foreign currency account of his own. So, but if it happened to be a asset which is in the nature of the residential house, or it could be a commercial property, then we need to understand how it has been acquired. Whether the NRI has acquired by paying foreign currency from abroad, or whether he has taken a loan in India and he has paid amount of EMIs through a foreign currency remittances, or he might have used any of these liability discharge or sale consideration payment from his NRE account. In that case, the principal and the profit accrued out of that particular asset both can be remitted out of India without any limits. I just try to recap or repeat at the cost of the repetition that if the property is acquired out of foreign currency investment, either by way of sale consideration paid in one go, or out of loan acquired in India, a loan taken in India, and he has remitted foreign currency for EMIs from time to time, in that particular case, there is no restriction on the amount that can be taken out of India, both in initial investment, subsequent EMI repayments, as well as the profit thereof. Now, let us presume the asset happened to be still a house property or a residential commercial property, and it is gifted to him from another non-resident. So if the donor, who is a non-resident, happened to buy the property in the similar form, that is by forex remittances from time to time, then also there is no restriction on remittance. But if it happens to be a resident has given gift of that property, in that case, what the non-resident can take is up to $1 million per financial year. Both the principal, I mean the entire capital gain, we need to see under $1 million per financial year. This $1 million is nothing but any remittances from non-resident to non-resident account. In the sense, he might have one NRO account, and from that NRO account, he want to take the entire sale proceeds net of taxes. In that case, the maximum amount that he can take is $1 million per financial year. And in case it happens to be an inheritance, in the sense, a resident has either by way of will or by way of inheritance through legal means, the property is passed on to the non-resident. In that case, same way like how we talked about the other matter, that entire sale consideration net of taxes can be taken only under $1 million scheme. And in sometimes we have seen the cases where NRI might have bought on his own name, but unfortunately, the consideration is paid through his relatives' accounts. Like suppose his parents are here or his friends are here. Sometime I have seen a case where a chartered accountant has facilitated considering the relationship with the client. But in case the sale consideration is not initially paid from non-resident account to the that is non-resident buyer account to the resident seller account, in that case, unfortunately, even though the payment is made in foreign currency, but since the link is missed between the seller and buyer, the remittance from seller and buyer, then they have to undergo the $1 million scheme. So even if we know the law, if the process is not followed, unfortunately, the remittance is restricted under $1 million. So this is what is about the capital gain. And sometimes there could be a case where a widow or widower of a non-resident who the non-resident who might have bought property while he was in India, or even he himself bought property and he is still alive. In any of these cases, if the property happened to be bought while the non-resident used to be a resident, still then also this $1 million scheme will be applicable. In the sense, self-acquired property while a non-resident happened to be a resident, or a proper channel is not followed for remittances from abroad. Even we have seen cases where the remittance even drawn in cash and paid to the seller. But in any of these cases, the only method is the total sale consideration minus taxes. Any amount left over can be taken under $1 million. If the amount happened to be more than $1 million, which in some of the cases we have seen, because commercial properties might be sold $2 million, $3 million, or $4 million, whatever the case. In that case, they have to make it as a tranches. They have to take each financial year $1 million. So that's why not only the method of purchase, even the process of purchase is equally important, the consideration payment. So I believe I tried to clarify. I think RP, have I addressed all the things, or anything that left over for this person?
Sir, because last session, some more people asked how many houses I can sell and how can I repatriate? Because under some cases, 2 or 3, something like that. Can you clarify on that one?
Yeah, under immovable property regulations, any non-resident buying 2 houses, two houses or more, the remittance under this, if the money happened to be invested through foreign currency remittances, then there are no restriction both on profit and principal. But it happened to be in such a way, suppose a non-resident has one land and later it got developed and there are residential properties have come up. Then the question comes is whether should I take all of them as one house or each flat as an independent house. Here, unfortunately, under FEMA, there are no clarity, but normally RBI take it as 2 independent houses. Sometimes, suppose the owner happened to get, say, 10 flats, then there are nothing but 10 houses. So, the profit that can be taken is only on maximum 2 houses. Anything beyond 2 residential houses, we need to go and take RBI approval unless the amount is covered under $1 million scheme. Okay. And for commercial properties, there is no restriction. There is no upper cap. Any number of property they can take it. But the only restriction I am just reiterating is agricultural land, farmhouse, and plantation land. These 3.
Yeah. Thank you, sir. Thank you, Murali. Yeah. So, from audience, okay. If you have any questions on capital gains, we will take up right now before we move on to the other remittances, some other instances.
But maybe not on capital gain. We had another question in the chat box. Interest payable to NRI partner, is it subject to TDS?
Okay. Interest to NRI partner. Okay. See, sir, the question is very immense, sir. What we need to understand is, okay, whether it is chargeable to tax in India or not. So ignore about 195 first of all. Whether it is taxable in the hands of the partner or not, if he is a resident partner, non-resident, whoever. So interest remuneration to the extent allowed under 40B that is taxed in the hands of the recipient partner. I hope that that is the legal position. So if that is the case, then whether he is a resident or non-resident, it is taxable. And when you are making a payment to non-resident, definitely 195 will be attracted. 195 will be attracted to the extent it is taxed under 40B. Okay, so to the extent it is allowed under 40B. Sorry, yeah. I hope that I am clear about that particular question. You know? Yeah. Just give me a second. Yeah. Yeah, the next issue here is many a times what happens. See, some of the cases R&D cost, those things are not taking. I will share the PPT along with the case laws I have given. So whenever you have any specific thing, you can refer this PPT. Okay, for guidance. So the next thing is most of the times what happens is clients approach us and they say that sir, we are making remittances towards the reimbursements. We have to be careful about the reimbursements. What do you mean by the reimbursement? So bills like a traveling bill, lodging bill, etc., which the other company has incurred and they have paid first and later on you are reimbursing, definitely reimbursements, since they are profit neutral, then TDS is not attracted. So that is a point which I want to address. The logic is very simple. Since it is a profit neutral transaction, no need to deduct the TDS on the same. The next question is, sir, many a times they are importing the capital equipment. They imported a machinery for $1 million and the cost of the machine is $1 million and it is import of machinery, there is no TDS, definitely. But the question here is, sir, on that there is an installation charge. I have to pay some $5,000 extra as an installation charges to the non-resident. Then sometimes the client argues that, sir, entire $1 lakh plus $5,000, $1,05,000 will be capitalized in my books of account. So there cannot be any TDS. Like that, he may argue. No, it is not like that. So far as non-resident payments are concerned, what is imported, how much is the cost of machinery? It is only $1 lakh. How you are treating in your books of account, that is secondary and separate. $1 lakh is towards import of machinery. On that there is no on that there is no TDS, definitely. But on the $5,000, since it is an installation charge, you need to examine which treaty you are talking about, and if there is a fee for technical service component, definitely it is liable for TDS under 195. So that aspect also one needs to remember. Okay. Then the next thing is, many a times the parent company sitting outside India, sitting outside India, what they do is, they take software licenses outside India, software licenses, MS Office license. MS Office license, if you purchase 25 or more than 25, Microsoft is giving an discount. Assume that it is giving. So the parent company has taken those licenses and started allocating those costs to various entities across the globe. Whether TDS is required to be done or not? Yes. Remember, if it is MS Office license, definitely it is liable to, it is attracted. On the other hand, if it is a insurance or use of web area network, etc., so which is a head office expenditure purely allocated, so then it is nothing but a pure cost sharing. TDS is not attracted. Understand the difference between the first and second. The first one is a license is taken at the corporate level. That licenses are distributed to various entities. So the license is covered under the royalty definition. License is covered under the royalty definition. Okay. So that is the reason why if a MS Office license, like if it is distributed across various entities, TDS will be attracted. Okay. So, but again, there are cases where you can take the treaty benefit. You can take a very aggressive stand saying that, sir, MS Office, I want to argue it is a copyrighted article rather than a copyright. Of course, we will hear soon from the Supreme Court, because the matter is with the Supreme Court. A bunch of 30 more than 30 appeals are pending in the Supreme Court on this matter only. But as of today, the industry, most of the cases, and the majority of the judgments also support that the MS Office, like where there is a license component is involved, then there is a it is treated as a royalty. Once there is a royalty, then TDS is attracted under 195. So that is another aspect. Okay. Then salaries, you can ignore that one. Okay. Branch office. Okay. Yeah. If you have any aspect related to shipping company, yes, just okay, being Vizag, better to cover, because some of our members may be dealing with giving 15 CBs with regard to this one. So when you are giving to shipping companies, non-resident shipping companies, so with regard to the freight, etc., you are giving a certificate, then you need not deduct the TDS, for the simple reason that, because if it is a non-resident shipping company, then they will be governed under a separate code itself, section 172. As the fellow members are aware of that, under section 172, they will pay the entire tax liability before the departure of the ship, or they make arrangements in such a way that the TDS is paid at the most within a period of 30 days of the departure of the ship. So, since the basic tax itself is paid under 172 through accelerated recovery mechanism, accelerated payment mechanism, there is no concept of TDS. So, TDS is a machinery section. So, when the normal tax itself is paid, everything is in advance, because of there is a specific requirement under the Act, then it overrides other sections. So, you need not do TDS. Okay. So, interest branch, ignore that one. Okay. Yes, the next interesting question is, before I move on to royalty fee for technical, so these are miscellaneous, like, sir, training. Okay, the non-resident trainer came to India, and he has given a training in India. Then we are making payment whether TDS is attracted or not. Yes, if it is a training, definitely yes. Training in the sense that they imparted the knowledge, then it will become fee for technical service. Otherwise, it is no. The next one is, sir, I am making payment in kind. So whether TDS is attracted, definitely. See, this is very much valid from the domestic perspective, 194 series or 195 series also. So here I have written the AP High Court judgment. Later on, it is followed. Sorry, this view is upheld by the Supreme Court in Kanchanjunga Seafoods case. Okay, so payment in kind is also liable for TDS. Okay, online subscription. Okay, so before I move on to royalty fee for technical service, TDS on online subscriptions. So, sir, whether TDS is attracted with regard to the online journals? So we need to examine what they are giving. If you have been given an access to a database, something like that, then it becomes a license. Once it is a license, it will be falling under the broad definition of royalty. Hence, TDS is attracted under 195. On the other hand, if it is towards a hard copy journal, like okay, Harvard Business Review, it is a hard copy, then definitely it is a book, so TDS is not attracted. That distinction we need to make. Okay, right. So in the case of e-journal also, TDS is not attracted. It is as good as a printed journal only, but available in e-form. On the other hand, if they are allowing you to access a database, like for example, you subscribe to Taxman, and they are giving access to a set of 20 years cases. So then they are giving an access to database. You can argue that, sir, how it is different from a journal? It is also printed. If I can take a print, etc. No, it is not like that. It is in a structured form and it is made. So you can do some navigation, all those things. So the more the dominant test is like it is nothing but giving an access to a database rather than giving to a book, etc. That is the reason. So why it is TDS is attracted in the case of like amount being made to taxman journal. I'm taking from Indian context, but if you are making to a similar thing to non-residents, then definitely TDS is attracted. So these are some of the miscellaneous. Okay, from 195. Then let us spend some time on royalty and fee for technical service and the related TDS. Okay, so then the royalty. Okay, so after that, we will learn from Murali sir whether any FEMA restrictions are there, RBI restrictions are there, or whether any cap is there on royalty payments. Can I pay 5% of my sales to non-resident as royalty? Because many a times when we are signing the 15 CBs, we simply say that, okay, royalty, we will pay. So we will see the DTA, we will see the tax rate, etc. We will get the TDS and we will say yes. But what we need to understand is whether there is a RBI check on that or not. What is the cap? That also better if we understand that one also. Then interest royalty fee for technical services. Okay. See, these are passive incomes. Okay. So there are deeming provisions are there in the IT Act. Okay. So only if you want me to explain this alone, royalty, interest, and fee for technical service, even within 6 hours also we cannot comprehend this one. But to the extent possible, I will limit the discussion to the more recurring aspects. Okay. So what are the principles? First, the taxing principles first we will understand in the case of interest, royalty, fee for technical service. Why we are understanding the taxing principles? For the simple reason that if it is taxable in the hands of the non-resident, then only TDS is attracted. If it is not taxable in the hands of the non-resident, then there is no question, no need to worry about the TDS at all. Okay, right. So first we need to understand the taxing point. So under what circumstances it is taxable in the hands of the non-residents? What are the guiding factors? Right. From Act perspective, we'll understand. Then after that, we'll understand from treaty perspective also. Okay. Right. So far as interest, royalty, fee for technical services are concerned, we will examine who is making the payment first. If your client is government, for example, AP government has approached you and they're saying, sir, we are making payment to a non-resident. So they're asking you to give a certificate, what you will do. So then if a resident Indian came to you, or third non-resident came to you. So we are talking from payer perspective. So if the payer is a government, interest, royalty, fee for technical services are paid by Government of India, then it is deemed that it is accruing in India. Once it is accrued in India, taxable in India. Once it is accrued in India, it is taxable in India. So we need to remember that particular point. Okay. But in the case of governments, there are certain exemptions given under 10 series. You can go through those, like specific cases, like defense related royalties, they are already exempted. For example, Ministry of Defense is making payment to Rafale, or it is making payment to Bofors, it is making payment to Dasport. So all these cases, what happens is, since they are related to the security aspects of India, the royalty, fee for technical services were exempt from taxation. Similar rule is applicable for interest also, right? On the other hand, if the interest, royalty, fee for technical service is received from a resident in India, then in such case, generally they are deemed to accrue or arise in India. But if it is in relation to business outside India, then it arises outside India, TDS is not attracted. Let me give an example. Then, so then you will understand this particular aspect. Your client is a resident. He came to you and he asked, sir, I am making $10,000 to a non-resident, whether TDS is attracted or not. Then we need to examine. Generally, if royalty, fee for technical services, interest is paid by resident to a non-resident. Generally, it is deemed to accrue or arise in India. Accrue or arise means it is taxable in India. It becomes Indian income. Indian income is taxable in all the cases. Okay, sir. We understood up to that particular point. But if you are able to establish that it is in relation to a business outside India, then TDS is not attracted. Will give a wonderful case on this point. Bajaj Hindustan Limited case. In Bajaj Hindustan Limited case, what happened was Bajaj Hindustan Limited is an Indian company. They are manufacturing pulsar bikes. We know Bajaj company. They are manufacturing pulsar bikes. What happened is they are setting up a plant in Brazil. It is their idea. They want to set up an offshore manufacturing facility at Brazil. So they want to set up a facility at Brazil. In that connection, what they asked is, they appointed KPMG Brazil. They appointed KPMG Brazil, and they asked, sir, can you do as a feasibility study from various aspects? Then KPMG has done so much of research, and they have given, apart from various things, they have given tax implications if you set up an entity in Brazil. So Brazil, what is the VAT law? What is the GST in Brazil? What is the income tax in Brazil, etc., etc. Now, Bajaj Hindustan Limited has paid $250,000 to KPMG Brazil. The question here is whether TDS is attracted or not. Remember, generally, when a resident is making payment to a non-resident, so Bajaj Hindustan Limited is making payment to KPMG UK, KPMG Brazil, generally TDS is attracted because it is an Indian income. But if you are able to establish that it is for the purpose of business outside India, so in that particular case, then the assessing officer has issued a notice. Bajaj Hindustan Limited has successfully demonstrated that, sir, I paid to KPMG Brazil not for expanding Indian business. It is for setting up of a business in Brazil. So it is for the purpose of my future expansion in Brazil. That is the reason. So for business purposes outside India, hence income accrues or arises outside India, then TDS is not attracted. See, I'm talking purely from Act perspective. There are some cases where once it is taxable as per the Act, then we will look immediately into the DTI. The DTI may give sometimes beneficial provisions. So we will take the benefit of that one. Okay. The third one is non-resident to non-resident. So I told you, Government of India is making payment always in India, arises in India. Resident to non-resident generally arises in India, but if your client is able to establish that that is for the purpose of business outside India, TDS is not attracted. Non-resident to non-resident, then generally TDS is not attracted. But one non-resident is making payment to another non-resident for the purpose of a business in India, then definitely it will become Indian income. Once it becomes Indian income, then TDS is attracted. Sir, what do you mean by TDS is attracted in those cases? Okay. See, one non-resident is making payment to another non-resident, but that is a chargeable to tax in India. Then in such case, it will become Indian income. Then TDS implications will arise. So the popular case on this matter is Linklaters case. In Linklaters case, what happened was Linklaters is a popular legal consulting firm, very famous legal consulting firm in UK. So one client in UK approached Linklaters UK. So client is in UK, Linklaters is also in UK. What they asked, sir, I want to set up a plant in India. Can you give me what are the tax implications if at all I set up a plant in India? Then they are given a wonderful report, a 200-page report where they give. Normally, they give like that only. Everyone gives like that only. Reason is very simple. Our act is so complex. If you ask me what is the TDS rate, if it is the capital gains rate, how many sections we have to see? Everyone knows. We have to check 112A, we have to check 112, we have to check 111A. Then after that, Section 55 substitution benefit, January 31st, 2018 rates, indexation. Some cases indexation is not available. 48 first proviso. All those things we have to remember, then only we can come to a conclusion. There is no standard or straightforward answer. That is the reason. So what they have done is they have given a very detailed report and they are given. Then later on, the government of India came to know that they are given. How they came to know that that is not our cup of tea. Later on, the Department of Indian Income Tax Department issued a love letter to Linklaters LLC. They asked, "So have you paid taxes in India?" No, no, I have not paid taxes. Okay, fine. Who is the person who has paid? The other person, client in UK. They issued a letter to client also, notice to client also. Sir, why you have not deducted TDS on the amount which you paid to Linklater? He is saying, sir, what nonsense you are talking? I am a non-resident. I am in UK, and the other person is also UK in UK. Then how you are asking me to deduct TDS? But our Indian Income Tax Act says that if it is in relation to business or profession in India, then TDS is attracted. Then they argued, vehemently argued this before the tribunal later on, Mumbai High Court, everyone also accepted, saying that arguments I will explain. Supreme Court judgment also I will explain. You may also get a doubt, sir. Sir, one non-resident to another non-resident, you are talking that TDS is required in India. How come that that is, and how foolish it is? But unfortunately, it is a larger bench Supreme Court judgment also. GVK Industries, 5-member Supreme Court judgment. Eli Lilly case is also there. Electronic Corporation case is also there. The popular case is GVK case, GVK Industries case. Right. What they challenged in this Linklaters case is, sir, number one, I am a non-resident to another non-resident, I did not deduct TDS, even if it is chargeable to tax in India. Like that they argued. So first question is no, since it is for the purpose of business or profession in India, then TDS is attracted. Okay. Then the next argument which they have taken is, sir, your section 1, you please open section 1 of the Income Tax Act. Section 1 says that it is applicable to the whole of India. India does not include UK. We know that one. Then can 195 override section 1? Section 1, like that they started argument. In GVK Industries it happened. Then the Supreme Court held that generally, the Parliament doesn't have any authority to make a law which has extraterritorial application. Generally, but merely because some of the sections have extraterritorial application, on that ground alone, you cannot hold that that particular section is ultra-vires the Constitution. In simple terms, generally the Parliament cannot make such type of law. But if some of the sections, some of the machinery sections are traveling, and then it is perfectly valid. But the Indian government cannot directly enforce that provision. If you want to enforce, you should have a available machinery. What is the machinery? DTA. So you should have a mechanism whereby you can recover. That person says that, sir, I won't reply to this notice at all. What you will do? Then can the Indian government can recover? Yes, it has recovered from Linklaters. What it has done is, so the Singh officer has prepared a 222 certificate, that is a tax recovery certificate, and they escalated the matter. 228 and 228A also, recent amendment also support the same thing. Then the CBDT handed over that to UK government. UK government collected the taxes and then handed over to Indian government. Because in the treaty there is a provision. In the treaty there is a provision which says that where your country people or my country people has evaded or escaped or dodged the provisions of the act, then they are saying that we won't pay. Don't worry, we will recover and remit. So through using that mechanism, they recover the taxes from Linklaters. But even before that one, Linklaters and the other client, they paid once they lost before the Mumbai tribunal. Even though they are challenged before the High Court, but they paid. The case is argued for 16 years. You refer that particular judgment. So, right, okay. So the conclusion here is one non-resident is making payment to another non-resident, but that is for the purpose of business or profession in India. Definitely TDS is attracted, but we may have our own doubts how the Indian government knows how the Indian government can recover. They are secondary, but as a principle, it is liable for TDS. Then, before I move on to the treaty, we will listen something from Murali sir. So Murali sir, people are paying interest royalty fee for technical services to the non-residents. Are there any cap, or can we directly pay to the non-residents without RBI approval? under what circumstances we have to take RBI approval. Can you throw some guidance on this one, sir?
Yes, sir, sure. Friends, like basically under interest, if you see loan or any of these things, if it happens to be a loan, we call it as external commercial borrowing. So whenever it is a loan, we need to go through the ECB regulations, where ECB regulation has a stipulated cap on interest. Normally, in the recent amendments that we have seen, it is maximum 4.5% over LIBOR rate, or when 6 months average LIBOR rate plus 4.5% is the maximum cap. But if it happens to be a INR loan from a non-resident, then there is no cap. In the sense, if it is happens to be we call it a masala bond or INR bonds. In that case, there is no cap, except it says that it has to be tagged to the State Bank of India prime lending rate or relevant benchmark. It means normally for interest, there is a cap, be it as under ECB regulation, either as it's a foreign currency loan, or it is a masala bond or rupee denominated bonds, normally what we call RWO. But for FIFA technical services, there is no cap so long. I'm sorry, I think there is, yeah, in one situation this has been come into picture, that is for project consultancy, because it may happens to be a fee for technical service related to a infrastructure project. Then the maximum amount that can be remitted without Reserve Bank of India approval under current account transaction rules is $10 million. But for any other project, it means, say, suppose a normal construction of building, which is not an infrastructure project. Okay, in that case, it is $1 million. So in case of a construction project, which is infrastructure project, like suppose L&T Hyderabad is building has built the metro train project. So it's an infrastructure project. Similarly, I believe, say suppose in the AP for Vizag, there is a proposed metro project is there. So somebody is providing consulting service for designing the project, then it is called as infrastructure project. Then the maximum cap under current account rules is $10 million. Anything above that, we need to go to RBI and take approval. For any other fee for technical service, it is $1 million. So these 2 points are clear. Fee for technical services.
Sir, one thing, sir.
Yeah.
I repeat, so $10 million for construction project and $1 million for other things, sir.
Other projects.
Sir, it is project wise we need to count, or it is assessee wise we need to
project wise.
Project. Yeah. Okay. Yeah.
And in case of sometime, I don't know, fee for technical service with respect to real estate sale, because sometimes it could be a commission or it could be technical service. Sometimes it depending upon how we go. But normally it is $25,000 is the cap. In case it happens to be commission on sale of real estate. But if there is any possibility of fee for technical service is tagged to this, still it will fall under that. Okay. So that's why we need to be cautious on that. $25,000 or 5% of the sale consideration, whichever is higher. Okay. So that is one thing. Coming back to royalty. So until 2009 September, there was a cap whereby it used to be on export sale, we can pay maximum of 2%. And in case of the domestic sale, we could pay maximum of 5%. And in composite, it is 8%. This used to be the restriction. But in December 2009, by virtue of a press note, that is 8 of 2009, the central government has removed any cap on payment of royalty. So from December 2009, there was no cap, there is no cap on payment of royalty. So this is what is the foreign exchange regulation in terms of this. Yeah.
So suppose what happens, sir, because sometimes without checking, it means many of our fraternity members issued the TDS certificates, 15 CVs, etc. Then suppose it crosses the limit, and AD banker also has not warned, and so it went because particularly the commission aspect, 5% or 25,000. Many times we have seen that the thresholds are crossed. In those cases, how the RBI will take the measures, sir? They will recover, or they will go for some penalty or compounding, sir?
Good question, sir. Basically, whenever under FEMA, as of now, the CA fraternity is not becoming victim because we are giving a certificate under income tax law, not under the FEMA, first part. Second thing is, in case a resident remit any amount beyond the specified threshold, nothing but they violated the foreign exchange regulation and they are exposed to penalty under section 13 and 15, which is amount up to 3 times of the amount involved. Under FEMA, please remember, any non-compliance is exposed to 300% of the amount involved, and in case the amount happens to be an excessive amount, RBI may give a direction to bring the excess amount back. But sometimes if it is not recoverable, no problem, only penalty. So this is how we have to see, but penalty is inevitable. And it is subject to discretion of the compounding in case we are going for compounding. If it happens to be adjudication, that is through investigation and all those things, then it is the adjudicating authority who can decide the penalty, but the amount can go up to 300%. It can be anything between 0 to 300. But normally these days, for these kind of exceptional cases, RBI is levying penalty based on many factors, but generally it is going up to 100%. So even 1 crore payment excess may lead to 1 crore penalty. Like that, we have to be very cautious.
Yeah, good information, sir. So I believe that for major payments, whenever there are major payments, at least we have to take anyway FEMA experts buy-in also. Apart from it, the things are happened before tax audit itself. Better to advise clients to go for a health check under FEMA aspects also. Because recently I have seen some of the cases where they have gone to investigation ED, and then see, RBI, it means at least it would have gone with the compounding, but ED means it is a painful process. We realized.
And no compounding also.
And no compounding, that is the biggest problem.
Because so, normally ED is levying penalty up to 3 times.
Yeah, they don't have mercy also.
No mercy.
So at least we, in big cases, better, sir, we will get a sanity check, or sorry, a health check, FEMA health check. So you are accessible to us, so we are merciful.
Thank you.
Right, sir. So coming back, sir, any doubts in our royalty fee for technical services so far as Act is concerned? Because I'm not going to the definition of these things. Directly, I will go to the treaty, and how to read the treaty I will explain. From audience, if you have any doubts, you can ask, sir.
RP, I think there are two questions. I think one is related to you. I think you can have a look at it and answer so that.
Yeah.
You may take another question.
I could not see it, sir. Can you read, sir?
Yeah, in chart there are 2 questions.
No, chat box is not visible to me. That's why I'm asking.
Okay. Mr. Kamsastri has put a question that whether the 15 CB is required for 172 transactions. I think first you can answer that.
Yeah, for see, sir, 172 overrides 195, sir. So 15 CB is notified only under 195. So since 172 is overriding 195 along with the related forms, so 15 CB is obviously not required. But some bankers are asking, but when we explained this, they stopped asking also, because with that port clearance certificate they got, and with that declaration that is over, sir. 15 CB, in my view, it is not required because 172 overrides 195. Apart from 195, related forms notified under 195, because 15 CB is notified under 195 section only. So that one.
Yeah. I'll answer another question. Later part, there is one common question which we need to answer. Yeah, there is another question. Since it's a Galaxy Note 9, I don't know whose name it is, but I will read out the question. In connection with receiving membership fee, we give wearing pin having our emblem to the members. Will it be okay? So I think the earlier question under FCRA, I believe this is being connected. So whenever it is receiving anything in goods or service, and any membership received or any payment is charged for that, there is no problem. It is a current account transaction, not falling under FCRA. Since it's not a FCRA transaction, it is permitted under the FEMA under the regular transaction. So this is one. Then another question from Mr. ROL Nursing Home is that if asset is purchased in INR by person from Indian origin and asset is sold by NRI now, can he repatriate the total amount of sale consideration? And what are the conditions applied in IT Act and FEMA? So first I'll try to answer the FEMA. I think then you can take up the import tax matter. So in case the asset is purchased in INR, but it is not clear from the question whether it is purchased while he is a resident or non-resident. So I'll put both situations. So if the asset is purchased while he is a resident in India, and now he is selling to being even it is a resident or a non-resident, depending upon the nature of asset, yes, of course, the transaction is permitted subject to $1 million, provided the asset is not the restricted asset, that is agricultural land, farmhouse, and plantation house. Sorry, plantation land. So irrespective of the payment, what is important is whether he is a resident or a non-resident. So if he happens to be a resident, then now he is a non-resident. I mean, he has purchased the asset while he was a resident, and now he is a non-resident selling the asset, and it is not a prohibited asset, then yes, the payment can be remitted net of taxes. But the only thing is, we need to ensure is that it is not more than $1 million. If it is beyond $1 million, they have to take specific approval from Reserve Bank of India. And option 2, I mean, in a different scenario, if he purchases the asset while he is a non-resident and payment is made in INR, but from NRE account. So if it is NRE account, then obviously the principal and the profit can be repatriated. Principal without limit, because whatever amount has come, it is going out. Profit with the net of tax, it can be taken out of India. But if it is an residential property, because here the answer is not so simple, I am trying to be as detailed as possible. So if the property happens to be a residential house, the profit is going under the $1 million, but the principal is going under the normal forex remittance. So again, we need to see 2 houses restriction as well. So if it happens to be not more than 2 residential houses, yes, profit up to $1 million, they can take it out. Principal based on how much they remitted from abroad, because the transaction might have happened in such a way that the amount has come from the money has been routed to the NRE account. In that case, it is a repatriable transaction. Hence, the total principal can be taken out. But if suppose it happens to be NRO transaction, or sometime he might have local proceeds which are used for this purpose, then principal plus profit all put together, it has to go under $1 million scheme only. This is what, we are not the payment. First of all, his residential status, nature of property, how much amount he remitted from abroad sources, and now how the property is been taken out. And there is one more situation. The non-resident, while he was a resident in India, might have bought an agricultural property. And later, agricultural property got converted into non-agricultural purposes, because that's how normally these days the cities are expanding. So in that case, now it is a non-agricultural land, and this property is now been it is sold out, and the remittances are being happened. Whether it is permitted, this is a different scenario, because generally we will see that okay, he is a resident, so bought agricultural land. Is it permitted? Of course, yes. But the asset, the agricultural land, must have been bought while he was a resident in India. Or the agricultural land, if it is inherited from their relatives, I mean his father or whatsoever, then in that case, no problem. The asset can be converted into non-agricultural purpose, and the property up to 2 houses, related profit and principal, it can be taken under $1 million. But selling agricultural land by a non-resident and taking the property abroad, not permitted. So these are the scenarios, because one question leading into around 8 to 9 scenarios. So we need to be cautious, because the question may be simple. When we dig deeper, when we take all the documents, we need to see that what is the nature of property while it is purchased and sold, what are the sources that are used, what is the process through which the remittances are made. I mean, initial transaction, because sometimes, unfortunately, due to the what you call any number two transaction or whatsoever, there could be a possibility that some of the money might have been remitted through foreign currency, but that might have been drawn in cash and paid. Can we take entire amount? No. Whatever is officially paid, that is eligible for repatriation. So that's why we need to be very cautious in all these possibilities. And now I think, yeah, under income tax, I think RP, you can please.
See, the IT Act, when you are when non-resident is seller here, see, we are talking about reverse situation. The TDS will arise only when you are making payment to a non-resident. Here, non-resident is getting the income. So TDS, the question of TDS doesn't come here unless one non-resident is selling to another non-resident and the asset is located in India, then you quantify sale consideration and cost of acquisition or indexed cost of acquisition, and then that is on that there will be a TDS. On the other hand, if the non-resident is selling that to a resident, then there is no question of TDS here. Okay, because he is the seller, not the buyer. Okay, right. So
there is one more question. I think
yeah.
we'll take two more questions here.
Yeah.
Okay. I think Mr. Narzum has asked the same question, that whether $1 million per year or per person. It is per year and per person. So basically, non-NRI, if he is taking the amount outside India, it is for him, it is applicable. The ceiling is up to $1 million per the non-resident who is taking the amount abroad, and it is per financial year. So this is just a connected dot. Then another question Mr. Vasudev Murthy is asking is that whether under LRS we can make payment up to $50,000, that is $250,000. In such a case, is it necessary to make TDS even the payment below that limit also? So just I will touch upon LRS, I think then you can connect the TDS. Under FEMA, as we all understand, under LRS it is $250,000 is the maximum cap a resident can remit to a non-resident. And the nature of transaction can be for gift, donation, or even for study purposes, medical purposes, traveling, tours, etc. All it is a composite package. So in that case, when it is coming to TDS, I think, yeah, RP, you please give and give your input, and later I may supplement based on the connecting dots, please.
See, sir, whatever, when it is a chargeable sum, then you need to deduct TDS. But in the case of LRS pairs, what happens is when you are doing a gift transactions, etc., no. But there is the banker will collect some TCS on that one. It is not related to 195 at all. So the banker collects a separate charge on that one, separate tax on that one. So that section will be triggered, but not 195, sir. Yeah. Unless and until there is income component, there is no question of invoking 195.
True, because that government wanted to address a lot of revenue leakage. Hence, under section 206 C, recently, that is from 1/10/2020, the government has introduced mandatory collection of TCS if the amount is in excess of 7 lakh. So, and again, it is 5% is the rate of TCS that they need to collect. So one has to be, aware of this provision. Yeah, I think the questions are up to now. These are the questions. So we can move on.
Right, sir. Now let me explain from the treaty perspective. Okay, we understood from the Act saying that generally interest royalty fee for technical services under what circumstances they are arising. So first we will see who is paying. Then after that you can see the definition, because in the Act, if you see, there are some exclusions in the Act itself, but very few cases the exclusions are there. Luckily, if you are falling under the exclusion list, excellent. You can take that exclusion. You need not subject that payment for TDS. For example, you may be wondering, sir, what is excluded then? Because you just told me that from royalty something is excluded. Yes. If you see royalty definition under 911, okay. So there are so many explanations. Okay. So under section 9, subsection 1, okay, each subclass talks about different things. Okay. So 916, 915, 916, 917. These are related to 915 is interest, 916 is royalty, 917 is fee for technical service. If you see the definition assigned to royalty under the Act, there they excluded consideration received towards distribution, sale, or exhibition of cinematographic films in India. That is not liable for, that is not treated as a royalty. Ironically, if you see India US DTAA, that is there under the royalty definition. Okay, I'll come here. We'll spend some time here because in one of the client's cases, what happened was there is a case also supporting this view, Warner Brothers case. Okay, this person is a distributor in Hyderabad. So he is making a payment to US towards the exhibition rights in India. Exhibition rights in India. If you see, there are English movies directly they got, they'll be translated to Telugu and what is the popular name, Lakshmi Ganapati film, something like that. Okay. So these people, when they are making a payment to non-resident, let us take the live case, Warner Brothers case, what happened in that case. So Warner Brothers India Limited, there is a company, India Limited. They paid to Warner Brothers Picture Incorporated, USA. $1 million they paid towards that exhibition rights of a movie called Matrix. Matrix Reloaded. Matrix 1, Matrix 2, Matrix 3, Matrix Reloaded. So with regard to this particular movie, they paid $1 million to the parent company. So the department asked, sir, why you have not deducted TDS? So immediately they have shown, sir, under 916 royalty definition, if you see, any payment made by the resident to a non-resident, any payment by the payment to the non-resident towards sale, exhibition, distribution of cinematographic movies is not treated as a royalty. If it is not treated as a royalty, it will become a business income. Once it is a business income, it will be taxable in India in the hands of the non-resident only and only if the non-resident is having a permanent establishment in India. Then only if P is there, then only business income will be taxable. Then they don't have a PA in India. That's why they argued that it is not taxable in India, right? But the department argued that, sir, in Act it is excluded. But if you see India US DTAA Article 12, there it is given royalty for the purpose of treaty included consideration towards a sale, exhibition, distribution of cinematographic films. So the department has taken this time the treaty for charging this for invoking the TDS provisions. So then the assessee went on with the Act. You know the golden principle, whenever there is a conflict between the IT Act and the DTAA, the provisions which are more beneficial, or if the DTAA provisions are more beneficial, the assessee can take the benefit of the DTAA provisions if they are more beneficial. If they are not beneficial, he can go with the Act, as simple as that. And in simple terms, generally, if there is a conflict between the Act and the treaty, he can go with the one whichever is more beneficial, unless GAR is invoked. If GAR is invoked, you are denied the treaty benefit directly. So there is no other go. You can't play around saying that no, sir, I passed the treaty test, but you have to pass the Act test also. GAR, if GAR provisions are invoked, then you have to compulsorily you may be denied the treaty benefit. Okay, right. So then you need to see which is more beneficial. You will, if it is the Act, you will see the treaty also. In the Act, royalty definition excluded consideration towards sale, distribution, exhibition of cinematographic films, etc. So that particular thing, right? Software, all the things. Okay, I'll directly explain some of the cases after that because I need to cover a lot. Then the next thing is treaty. When you are reading the treaty, okay, if it is a fee for technical services, okay, then read the treaty, read the Act also. The Act definition is wider compared to the treaty definition generally. Okay, so you take the benefit of the treaty whenever that income is getting excluded. you are making $1 lakh to a German entity. $1 lakh to a German entity. That is towards fee for technical services. Then first examine whether it is passing the test of fee for technical services under the Act. If it is passing, then examine whether it is passing the treaty test. If it is passing the treaty test and Act test, then definitely there is a TDS. Then you need to deduct the TDS at the rate given in the India-Germany treaty. Right. I'll give two examples, two instances, live instances, which occur for most of the chartered accountants. Okay. So what happens in that particular case is, yeah, Siemens case. Many of the cases it happens. Okay. See, in Siemens case, what happened was fee for technical services. The Indian entity is making a payment to non-resident towards testing of the circuit breakers. Okay. So Indian entity send the circuit breakers to the German entity, and after that they paid $25,000 for testing the circuit breakers as testing charges, etc. Asking us issued a notice saying that why you are not deducted TDS when you are making huge amount to your German counterpart. They told, sir, let us understand the Act. Act, what it says, a fee for technical services. If you see fee for technical services definition, what it has given is fee for technical service include managerial, technical, consulting. What are the words used is managerial, technical, consulting. So fee for technical service includes managerial service. Fee for technical service includes technical service. Fee for technical service include consulting. Then what they have done is, sir, these three words are used without giving any definition in the Act. When more than one word is used without assigning a specific definition and all are of having equal force, then you will apply the golden principle of nocere socii. As per this principle, each word will take color from the remaining words. So what do you mean by each word will take color from the remaining words? The word managerial, consulting are there. In between, the word technical is sandwiched between the two extremes, managerial, consulting. Managerial, technical, consulting. So that's why the technical services will take its color from the other two words. So what do you mean by that? In simple terms, managerial service. Who can be a manager? Only a human being. Okay. So managerial service means those services where human element is involved. Then consulting services. Who can be a consultant? Generally a human being. So consultant means human agency is a must. That's why technical, only those technical services where human element is embedded, where human element is important, where human element, they alone will qualify for technical services under 917. They argued like this. Sir, managerial, only human being can be manager. Consultant, only human being can be consultant. So since the word technical is sandwiched between these two words, only those technical services which have a human element or which have a predominant human element, they alone will become fee for technical services. In simple terms, if it is a service done by an automated machine through an automatic process, that is not called as a fee for technical service under the IT Act. It may be a technical service, but for the purpose of 917, it is not treated as a technical service. So they argued that. In Siemens case, what happened? They sent the circuit breaker. So the circuit breaker was sent to there. Then the German company kept the circuit breaker and they kept under a machine. The machine checked that one, and for 20 machines it has given the green tick. Green means it is passed the quality control test. 5 machines it has given red tick. It means they have not passed the quality control. So the human being came and pasted the green stickers and the red stickers. That's it. The human element is very, very insignificant. Completely the examination, the checking, the diagnosis is done by the machine. That's why it is done by a machine. Hence, it is not treated as a fee for technical service even under the Act. Then the Mumbai Tribunal held that TDS is not attracted in this case. That's why if you see recently under the UN model, because when we are framing the treaties, we have a concept of following OECD model or UN model. In UN model, they introduce a new article called Article 12B to capture these type of things. And OECD model also, they talked about pillar 1, pillar 2, etc. broadly what they are trying to do is, okay, if it is a human element, we will go with the regular article. If there is no human element, an automated machine service, then in such case, there should be some more new article whereby the country should be capable of taxing the same. So they are in the process of amending the act. But as of today, so if it is done by an automated machine, TDS is not attracted. So that is the one. So assume that, sir, human element is also there. Then TDS under the act is required. Then you examine whether there is any benefit given under the treaty. Sir, what do you mean by the benefit given under the treaty? So the benefit given under the treaty means some of the treaties has most favored nations clause, and some of the treaties has make available clause. So we are discussing first make available clause. Then after that, I will explain MFN clause. So what do you mean by make available clause? So some of the treaties are having make available clause, like India US treaty, like India UK treaty, India Australia treaty, all these treaties, India France treaty, but France treaty through protocol it follows, but whatever. So these treaties are having make available clause. What do we mean make available clause? Make available clause means that technical service will become technical service as per the treaty only if the non-resident is making his knowledge available to the Indian entity. So what do you mean by that? Okay. So it has a human element. Okay. So under the IT Act, it passes the test. Now we are examining the treaty. If under the treaty, if the non-resident is making his knowledge available to the resident such that the resident can replicate the test without the help of the non-resident for future transactions, that is called make available. So I repeat that one. I give it a simple example. Suppose I am importing some knowledge to you. You understood what to mean by FIFA technical service. You understood make available clause. You understood the treaty. You understood SCP clause. You understood Article 9. All the things you understood. Then it is nothing but I made my knowledge available to you. It is called FIFA technical service. It means at a later point of time, with the knowledge which you acquired, you are able to apply that to an independent situation. That is called a fee for technical service. So when you are making a payment to the non-resident, you examine, okay, you are paying, I definitely agree with you. But whether the non-resident is making his knowledge available to the Indian resident, if the answer is no, then TDS is not required. For example, in most of the pharmaceutical companies, what happens is they pay amounts towards to the pharma companies outside Pfizer Corporation, but whoever, I'm not naming that one. So many Indian companies are making payment to the US companies towards clinical research activities. So the non-resident, what they are doing is they are giving the end report. So in the end report, what they are doing, so what is the uses of the drug and the ultimate outcome they are giving. Again, Indian entity, next time if they want to go, again they have to approach the non-resident only. Indian resident cannot on his own apply this, apply his knowledge. So the non-resident is not making his knowledge available to the resident. In such cases, even though it passed the IT Act test, it fails the treaty test. Then in such case, no need to deduct the TDS. So you carefully see the act. Then after that treaty, then if it is not covered under the treaty, excellent. If it is covered under the treaty also, then you need to deduct the TDS. So this is from treaty perspective. Right. Just give me 2 minutes. I will have some water. It comes. Just give it. I will have water. It comes.
So speaker has taken a break for 5 minutes. He is continuously speaking since 4 o'clock. It's been 2 hours, more than 2 hours. So he went to have a glass of water, sir.
Yeah, sorry, madam. Yeah. Now, let us see. So, we have examined interest, we have examined royalty, we have examined the fee for technical services. Then, I will give you one more idea through which what you can get is, sir, is there any way? Oh, wait, I will share the screen also. Yeah. Right, okay. So, the next thing is, I told you about ACT first. ACT, you examine fee for technical service means it should have human agency, and that human agency should be dominant. That is the first thing. Second thing is in the treaty, some of the treaties are having most favored, make available clause. So there the wording will be if the non-resident is making available his knowledge. So if the words are like that, then you examine that is implied that make available clause is there in the treaty. Then you apply that particular one. You apply that particular one. So if the non-resident is making his knowledge available, then only TDS is attracted. Then there is one more way in which we can take some relaxation, like MFN clause is there. Some of the treaties are having MFN clauses, most favored nation clauses. So what do you mean by this most favored nation clauses? Okay, I will give one practical illustration. India-Netherlands treaty is one of the good examples. Just give me a second. Yeah. Right. So use of MFN clause, how you can take the benefit. Okay. See, Netherlands treaty is there, and we have Finland treaty also. Okay. So I will illustrate how to take the benefit of MFN clause. First of all, what do you mean by MFN clause? So don't see this one. First, can listen to me. Those who knows, excellent. Okay. For the benefit of those members who do not know, I'm sharing this one. What do you mean by MFN clause? Most favored nation clause. So in principle, it means that, see, the treaty happens after a lot of negotiations and after a lot of deliberations. For example, India-US treaty is one of the longest deliberated treaty. It took 30 years for India to sign a treaty with US because after 30 years of deliberations, the treaty was concluded for the simple reason that our people say that we will deduct TDS on the amount which a resident in India is making payment to USA. But the US government says that no, don't deduct TDS at all. So as simple as that. So treaty is nothing but a foregoing of right in favor of the other. It is nothing but allocation of rights, sacrifice. So I sacrifice my right to tax in favor of the other country. It is in a way broadly nothing but a compromise between two countries, in the sense that they are allocating the taxing right between themselves, right? So some cases what happens is the treaty is not at all concluded. We say that the Indian countries, capital importing countries, we say that capital importing countries, that's why many of the cases we import the capital and the technology. So what we do, we import the technology. That's why we are making payment to non-residents. So we follow the UN model generally. UN model, what it says is it gives the right to source country. Source country means where the pair is there. The pair is in Hyderabad or Vizag or Telangana or India. So he is making payment to non-resident sitting in USA, France, Denmark, etc. Okay, fine, sir. Because he imported capital, he imported technology. Capital means interest you will pay, technology means you will pay fee for technical services. Right. So when he is making payment, Indian government people say that, sir, I will have a TDS 10% because your act is the 115A. But in the treaty also that provision should be there. Royalty fee for technical services will be taxed in the source country also. Source country means in India. They are arising from India. Okay. So the source country is in India. That's why the right should be given to the Indian government. So that's why they say that we will direct TDS of 10% here. Then the money will go to Indian government, but this amount will be given as a credit in the US or Germany when they are making a payment of the final payment of taxes. So the money goes to Indian government, but the credit is given to the US or Germany government, whatever. So then they say that we don't want to give a right to the source country at all. Sometimes what they do is, okay, here is the deal. I will give the right to the source country. It means I will give the right to do TDS to the Indian entity, Indian government. But if at a later point of time you are entering into treaty with another OECD country, another MFN clause concept is applicable only for OECD member countries. So India, France, India, Netherlands, India, Finland, all these are OECD countries. India is not member, but all other countries are OECD member countries. So they said that all the other countries, they said Netherlands and Finland, all these countries, they say that okay, for the time being, we are okay with this agreement. But after you sign the agreement with me, at a later point of time, you are signing an agreement with the other country, with any other country, and you are giving a favorable treatment to that person. The same treatment should be accorded to me also. So that is called most favored nation clause. I repeat, Netherlands we have, Finland we have. Okay. So in India, Netherlands, we have a treaty. Netherlands is a OECD member country. So we agreed. Already there is a make available clause is there. MFN clause is also there in Netherlands treaty. Then the next issue here is the moot point of MFN is after entering an agreement with Netherlands, if India is entering into agreement with any other country and India is giving a favorable rate to the other country, then that favorable treatment to Netherlands also. So that is called MFN clause. That is called MFN clause. If you see India-Netherlands treaty, it has MFN clause. MFN clause in the sense that for the time being, this is the meaning accorded to fee for technical service. If after we signed the agreement with Netherlands, at a later point of time, we are entering into treaty with any other OECD member country, through which we are giving some concessional or favorable benefit to that particular country, the same benefit is deemed to have been given to Netherlands also. That is the essence of this one. I will walk you through a live example where we are given certificate based on this one. Let's see here. See here our experience or our knowledge, not our means all of us. It doesn't me alone. I'm using plural. Okay. So we can help the client through these things. Okay. The first one is you need not read the treaty. I will explain. Extract from treaties, use of MFN clause using FTS. Netherlands treaty, it is notified with effect on 27th March 1989. So Netherlands 1989. Finland 1/4/2011. 1/4/2011. Okay. So Netherlands treaty has already a MFN clause. So Netherlands treaty, what they agreed is for the time being, this is the understanding for fee for technical service. But after this one, if you are entering into another treaty with an OECD member, yes, after 1989, we entered with agreement with Finland. Then in such case, if you are giving concessional treatment to Finland, then that concession should be given to me also. If you see Finland treaty, what it says is, okay, the royalty fee for technical services, etc., shall be deemed to last to let's just you see deemed to arise in the state in which the right or property is used or the services are performed. Okay, so rendition test is a restricted test which is there in the Finland treaty, which is not there in other treaties. Then when we are making a payment to Netherlands, what we argued is, sir, Act test it passed. Then the next is treaty test also it passed. But we want to take the benefit of Finland treaty. So in the Finland, as per the Finland treaty, it means whatever wordings are there in the Finland treaty, it is deemed that they have been imported into Netherlands. If you apply them, then royalty is not deemed to accrue or arise in India. So benefit should be given. I will give an example so that you will understand what happened in that case. Then only you will understand. Otherwise, it is little complex. Okay. See, there is a test called rendition test. There is a test called utilization test. Prior to the Supreme Court judgment in Ishikawajima Harima Heavy Industries case, the Supreme Court in Ishikawajima Harima Heavy Industries case, they held that in 2011, prior to 2011, I am talking about, they held that royalty, interest fee for technical services are deemed to accrue or arise in India only if two conditions are satisfied. Number one, the services should have been rendered in India and the services should have been utilized in India. It means Indian entity is making a payment to non-resident $10,000 for the purpose of Indian business. Yes, it is utilization test. Rendition test. Rendition test means the non-resident should come to India. He has to spend some time. Then only it is called fee for technical service or royalty. It means physically he has to come and do the services. This is old law. Then after that, they amended the law. If you see the explanation given below section 9, it says that for the purpose of interest, royalty, fee for technical services, utilization test alone is the required condition, and rendition test is not required. Rendition test means it is not necessary for the non-resident to have a business connection. It is not necessary for the non-resident to come to India in order to give rise to interest, royalty, fee for technical services. The conclusion is very simple. Indian entity is making payment to non-resident for the purpose of a business in India. Then TDS is attracted. This is after amendment. This is Act ignore now. Then the next one. India-Netherlands treaty says that make available clause. Yes, sir. The non-resident has made his knowledge available to Indian entity. That test is also passed. Then Finland treaty. Finland treaty says that the royalty or fee for technical services are deemed to arise in India if the services are really performed in India. So, where a person in Netherlands is sitting and is supporting through online, he has rendered services outside India, but the person is in India. It means the resident is in India. Non-resident is sitting outside India. He is doing online service there from. Then in such case, as per IT Act, TDS is required. As per Netherlands Treaty, TDS is required. But as per Netherlands treaties, MFN accessed as per Netherlands MFN clause. Through MFN of Netherlands treaty, I will go to Finland treaty. As per Finland treaty, the royalty or fee for technical services will arise only if the non-resident really come and rendered services. In this case, I will argue that non-resident never came to India. That's why TDS is not attracted. This is the way in which we need not deduct TDS. Okay. So like that, you can start doing the experimentation. Okay. So this is called MFN clause. Carefully read the MFN clauses in the treaty. Capital gains amendment are there in the Indo-Mauritius treaty. Just given the conclusion of this one. It means if the wordings are this one, because earlier seminar they asked, sir, the wordings are so complex. So can you summarize? Just given what is the summary of this one? Okay. Then okay. So before now, let me quickly explain some of the concepts like the recent ones. Okay, all these I'm skipping. MNIs. Okay, because we'll spend time on the ones which is required now. Okay. So what is this one? Okay. Now from 1/4/2020, MLIs are effective. So what do you mean by MLIs? Okay. Multilateral instrument. India has treaties with 95 plus countries, 98 countries. Okay. Now, under the OECD BEPS action plan, base erosion and profit shifting. So, what they have advocated is crores of revenue is getting leaked on account of the aggressive tax planning done by MNCs like Google. What is the effective rate of tax of Google? The effective tax rate of Google is very low. It is below 5%. Facebook, it is below 5%. So they are structuring their transaction in such a way that their effective tax rate is falling below 5%. So that's why the OECD countries, later on India is a partner. India is not a member of OECD because our per capita is not meeting the OECD standard. That is the reason. But they realized that India is an active partner. India should be recognized as an active partner. So they are given one special status to Indian government. It means whatever they will take the happenings in India also, right? So they're trying to renegotiate treaties. So what do they renegotiate in the treaties? Through treaties, they are abusing the tax treaties. So the purpose of a treaty is to avoid double taxation. But what they are doing is, instead of avoiding double taxation, they are achieving double non-taxation. See, the purpose of a treaty is in order to avoid double taxation. If I am paying tax in India, if I am paying tax in USA, so please give me some concession. You tax only in one country. Or if you tax in India, if you tax in USA also, whatever taxes in India that has been paid, you please allow as a credit in USA. Something like that. So the basic purpose is to avoid double taxation. But they are structuring their transaction in such a way that they are achieving double non-taxation also. Double non-taxation. So they realized this one. That's why what they have understood is, okay, let us put a permanent stop to this one. Let us renegotiate the treaties. So they are incorporating new clauses in the treaties. But remember, world over, there are thousands of treaties are there. A treaty is a bilateral negotiation between one country and another country. India has 98 treaties, so we have to start discussion with each and every other country. And I told you just now, India took almost 30 years to sign a treaty with the USA. So if you start taking 30, 20 years, 10 years, 5 years like that, then we will never reach a conclusion. That's why worldwide what they have done is we will have a concept called MLI, multilateral instrument. We will give some models to you. We will give some models to you. Royalty definition or fee for technical service definition. Of course, these are not affected through MLI. The PE definition is amended to MLI. PE, permanent establishment. PE means PE should include, PE excludes, like that they are given one definition. So well, they will give a standard definition. Then India will go to the other country. India goes to, suppose, see, as of now, 42 countries has ratified and they have placed with the OECD. These are the things which India has signed and they have accepted also. For example, Australia is there. This 42 list for the last 1 week. Okay, the status is updated up to last week. Okay, so India has signed with Australia on MLI. So India says that PE definition means this one for me. Australia says that okay, this definition is acceptable. Then it is deemed that India-Australia definition is deemed to have been modified to give effect to MLA. But it won't substitute the existing treaty. The treaty you have to keep, MLA you have to keep side by side. Then you need to see what is the PE definition given in the world and what is the PA definition given in the MLI. So if this is matching, it means in MLI we agreed, then you see the new definition, then you need to take a decision based on the new definition. As of now, 42 countries has notified the MLS with India. And Indian government has prepared synthesized text for 22 MLS. Synthesized text means in the sense that, what do you mean by synthesized text? We prepare the world, India-Australia treaty is there, okay. Then we agreed for certain modifications in the treaty. We are not amending the treaty. We agreed for modifications through MLI. So that's why India and Australia both, they agreed that paragraph number 5, PE definition, then hybrid mismatch agreements, etc., these should be changed. Then these are incorporated into the treaty and the Indian government has released a text called synthesized text. synthesize treaty. It means Act amended by impact of MLA. This is for ease of understanding, nothing but amended version of the treaty. Okay. So you have to see that one. Then based on that, you need to take a decision. So when our members, when friends, when you are signing the 15 CBs with these countries, I will share this PPT. Okay. I already shared the condensed version. I will share the detailed version, this one, which I presented, because the original plan was something different. Right. Okay. Because we want to have a combined PPT, it could not have. So I'll give detailed PPT. Signing any 15 then see the synthesizer test or see the MLI signed with this country, then understand the modified definition, then take a decision based on the modified text of the treaty. So this is called the MLI. Okay. So what do you mean by they are avoiding through double non-taxation? Double non-taxation. I will give you one example. Then after that, with 3 or 4 minutes. So with that, I reach the conclusion. It means, of course, we can discuss and keep on doing that discussion. I'll open the floor for some question and answers, and after that, Murali sir will add some more points. If they're ready, okay. So this MLIs, what we have to do is we have to keep them side, then the old treaty and the MLI. So some of the cases, even though India signed with 42 countries, but as of today, the Indian government has given synthesizer text with regard to 22 countries. Synthesizer text means treaty with amended version of the MLI. It means both are at the same place, like that. Okay, if it is not there, then what you have to do is treaty you have to keep, and the MLI you have to take. MLI where you can see OECD website. You just say click the India, then India and Finland. Then India to Finland, whatever is the corresponding, it will download. Then after that, you see the relevant paragraphs wherever it is changed. Okay. So non-taxation. So double non-taxation happens in the case where they will earn substantial revenue in a country where they have no rate of taxation, nil rate of taxation, or very, very less rate of taxation. Normally what they do is Ireland. Okay, so Ireland, many cases, Ireland, lot of exemptions are there. Okay, what they have done is, in Ireland, what they do is the patents. So the Indian entity will do R&D, etc., etc., or various countries, various companies in the group, they will do R&D. Finally, they got registered the patent, etc., in Ireland. That's why if you see LinkedIn, their server is in Ireland only. The reason is very simple. There is no tax rate or very less rate of tax is there on the server's income. Okay. Then server or the patent, everything is got registered in that particular place. So patent is one thing, server is another thing. Okay. So LinkedIn, if you see, the server is located in Ireland. So what do you mean by server is located in Ireland? If server is located in Ireland, it is deemed that PE is there in Ireland. Then if they have a PE, business income, it will be taxable in Ireland. So they are getting a lot of benefits in Ireland to the business income using the local laws. So they are not paying taxes in UK, in Ireland, and they are not paying taxes in the source countries like India, etc. That's why you have equalization levy. That's why you have different things. SCP, significant economic presence test you have, and thin capitalization rule. All these concepts have been introduced to address those plannings, to address those practices. So in typical cases, what happens is, I'll explain with the last case, Pinstorm Technologies or Yahoo case. What happened is Right Florist India case. What happened prior to equalization levy? What happened was Right Florist, they are paying huge amount to Google. So if you click something in Google, I want a flower bouquet shop, then in Google page you will be getting the first page. So if you are a paid subscriber, then your name will appear in the first 10 page, first page. Generally, we will see only first 1 or 2 pages. After that, we will never travel. Then, so once they paid on an advertisement, so the Google, what happens is it will list whoever has paid, that name will appear in the first. If everyone has paid, who has paid more? As simple as that. Okay. So Right Florist India is making huge amounts to Google Incorporated. Then they have not deducted TDS. So the department argued that it is a royalty. They argued royalty fee for technical service or something else. Then the the Right Florist argued that number one, it is not a royalty because there is no licensing at all. It is not a fee for technical service because there is no human being. It is completely driven through algorithms. So there is no human element involved here. So there is no fee for technical service. So it is a business income. A business income of Google will be taxable in India only if Google has a permanent establishment. Google has a subsidiary in India. Subsidiary is not treated as a permanent establishment unless subsidiary is treated as an agent. So Google India is acting independently. So it is not a PA. That's why Google's income is not taxed in India. So they escaped. But there is so much of user base in India. So Facebook, it has lots of users in India. Then substantial revenue is getting generated. See now, data, you may argue that, sir, Facebook is free for me. Facebook is free, but you see what do you mean by geo? If you reverse that one, O-I-J, if you, it all says O-I-L, oil. Reliance done business with oil. If you transpose oil into that one, geo you will get. Earlier, oil is important. Now data is important. That's why Reliance, what they have done is oil reversed, geo. That is the name. So now they are doing with the data. So if you give me data, then I can do wonders. Data is that much important for them. So Facebook has a lot of subscribers. So we feel that it is free, but it will ask the questions. You please type your birthday, all those things. Then immediately after some time, you will get a service call saying that, sir, we are calling from a Domino's Pizza. Do you want to order anything from us today for your birthday party? Something like that. First 2 times you will say no. After sometimes you may be tempted. Yeah, okay. Because they say that, sir, huge discount, 90% discount is there. That's it. So when you are not required anything, you purchase at least for 10%. So they are doing lots of business with the data. So India, they have only website. Website is not treated as a PA. In India, they are not paying tax. Ultimately, their website is in the UK or Ireland. In Ireland, they are not paying taxes because even though the server is there, the rate of tax or the concessions which Ireland government has given is very huge. To address these practices, DEPS, they have started with action plans. Lot of action plans. The temporary measure is equalization levy. After that, pillar 1, pillar 2, etc., etc. In a digitalized environment, how to tax, etc. How to change the treaties. The way in which they are amending the treaties is through MLIs. So, lot to go. Right. So, with this, I conclude from my side. Murali sir will add some concluding remarks. After that, floor is open for question and answers.
Yeah. RP, I think there are 2 questions, so which I wish to answer because they are both related to FEMA.
Please, sir.
So basically, one of the questions from Mr. Ashok Mirpuri, that an NRI remits certain amount to his relative residents in India. Out of the amount received, the relative purchase agricultural land is permitted. The question is more of a general thing. I want to make it a little more clear. That basically, whenever a resident receive the amount, there is a question that what is the nature of transaction? Is it a donation? Is it a gift? Is it a loan? Or is it repayment of any of the payment that need to be paid to the resident? So out of the 4, if it is a donation or a gift, donation obviously again may fall under FCRA, which I keep it aside. But if it is a gift, the amount becomes the own funds of the resident in India. Hence, it is a resident money. Being a resident money, of course, the resident is free to buy any of the agricultural land because purchase of land, agricultural land by resident is not restricted. But if it is a borrowed money, yeah, the non-resident being funding the resident cannot buy agricultural land out of the borrowed funds. So the difference is what is the nature of transaction? So if it is a borrowing, no such investment is permitted. And another one is this is from Mr. Dayakar, G. Dayakar. So resident in India received a loan from NRI. What is the procedure for repayment of loan with the interest to NRI outside India? So again here, whenever it is a loan from a non-resident, there are two routes that we need to see. Is it a loan in Forex or loan in INR? If it is a loan in Forex, the cap amount is normally $250,000. So out of $250,000, if the resident is borrowing that amount, the very purpose of that borrowing is only for the personal consumption, like construction of house, marriage of children, or for hospitalization of the recipient or their family members, etc. But this amount cannot be used for the purpose of the kind of what you call purchase of shares, investment in another company, or a investment in a partnership firm, or investment in property concern, etc. are not permitted. Once it is not permitted utilization, repayment is also not permitted. Please remember. So that's why we have to be very cautious that whether this is a permitted borrowal or not. But if the payment is received in non-foreign currency, normally the amount is non-repatriable only. It means the money has to reside in India only. And of course, interest can be paid if it is permitted by RBI, because on a foreign currency loan, it should be interest free. And the lender and borrower should be relatives. That is normally relative definition as per Companies Act we need to see. And based on these conditions only, foreign currency borrowing can be made. But if it is an INR borrowing, then the payment is again non-repatriable. But the only thing is, interest can be paid at a maximum rate of 2% over the prevailing SBI bank rate. So these are the two conditions. Then accordingly, the payment can be, means the loan can be repaid. So that's why these are the normal conditions. Of course, some of our slides are containing these details, which will be shared. And Bharti Garu, I think if you can confirm whether now it is 6:53, how much time we left over? Accordingly, we will plan for the further discussion.
So 10 more minutes, sir.
Okay, cool, no problem. Just maybe if it is permitted, I want to touch upon few of the FEMA critical cases. Because of the past of time, I could not take much, but I'm trying to give some of the insights, which normally our fraternity face on day in, day out basis. So I may share my screen just for 2 to 3 aspects I want to talk about it. Please give me 1 minute. I'll just share that. Yeah. Yeah. So whenever these days, because of a lot of issues that we are faced with, most of the times whenever it is import, what we need to be ensure is that whether import is overdue or normal imports, because for any of the imports, the payment that need to be made is within 6 months of the import. Anything above 6 months, it will become a loan. In terms of the FEMA, again, there is something called merchant trade, all those things are there that I'm not touching upon. But if it is a permitted transaction based on whether it is a raw material or capital goods, there is a maximum credit period that can be extended by the foreign supplier. The maximum credit period in case of raw material is 1 year, that is 12 months or operational cycle, whichever is longer. But in case of capital goods, it is maximum 5 years. So within this period, if this amount is not repaid, the credit period is exceeding that period, then it will be treated as a loan under the ECB regulations. So one has to be very clear on all these aspects. Again, there is a possibility of how much amount we can give as an advance before receiving the import of goods. The maximum import that the advance for import that can be paid for goods is $200,000 without any advance bank guarantee, ABG, not what normally we call. So in case of goods, maximum $200,000. In case of services, it is $500,000. But if the banker accepts it, then maximum is up to 5 million based on the banker's approval, specific approval. the amount can be remitted as an advance. But after import, within 6 months, normally, and in case of raw material, 12 months, maximum credit period. And in case of capital goods, that is for setting up factory or construction of building, etc., then it is maximum 5 years. So other aspects maybe a lot of inputs are there in these particular slides. So you may please go through it, and any doubts specifically we can address, and other things are there. I wish to take any more queries that are coming. Okay, I think Mr. Venkateswar is asking the question with respect to Mr. Ashok Mirpuri. He is asking to repeat that. What the question here is, if the amount is received from non-resident to his relatives, whether this amount can be used for purchase of agricultural land. My answer was that if the amount is received as a loan, then it is not permitted for utilization to purchase of agricultural land. But if it is a gift, which means gift becomes, once the amount is gifted, it becomes the absolute property of the donee, not the donor. So it becomes resident money. Once it becomes resident money, resident can use for any purpose, including agricultural land purchase. So that's why if it is a gift, yes, agricultural land can be bought. But if it is a loan, no, agricultural land cannot be bought. But if it is a donation, because a resident become kind of channelizing the donation to some other, because we are receiving a lot of queries that sir, I receive the amount from X person and I pay the same amount for purchase of some land which I will donate to a temple or something like that. In that case, if it is a donation, if the person recipient becomes the passive or conduit pipe, in that case, again, it is restricted under FCRA. So with this, what I can repeat is, loan and donations, be cautious, it is not permitted. But if it is a repayment of even any of the amount that resident was supposed to receive from non-resident, no problem, because earlier there was a existing debt from this. So accordingly, that fund can be used. But if it is a gift, yes, no problem, agricultural land can be bought. This is my what is the reply. Hope that we tried to give valuable input on this, and so we are open for any other query that is there. Accordingly, we can see that if some inputs are required.
Members, you can unmute yourself and ask the questions. Oh, the floor is open. I can't say the floor. The virtual mode is open for you to speak and ask. If no questions are there, we shall wind up, members. Hope during the session itself, maximum of the queries have been clarified, as the presentation was really like what the queries you have received while presenting to other branches or in other sessions also were being covered by both of you. Very well presented, sir. Really, the members present today has definitely benefited out of your seminar, sir.
Thank you. And
if no queries are there, we are winding up the session.
Thank you, madam.
It is on dot.
Okay.
Okay. I request our secretary, Vasudeva Murthy garu, to propose vote of thanks for the seminar. I hope some technical issue with Vasudeva Murthy garu. I request Prasad, treasurer, to propose vote of thanks for the session.
Good evening, respected chairperson CA.G. Bharti Dev Garu, respected speakers, past chairmen, senior members, and MC members. Good evening to all. Just we had seen one wonderful session on FEMA with the joint combination, and throughout the session they clarified all the doubts with very much patiently, and it is very knowledgeable session what we had for the continuously 3 hours, and we are very much thankful to Rajendra Prasad sir and for taking the longer session with combining, like it's a very good great combination where we had light and spark seminar just we have seen. Thank you very much, sir, from on behalf of myself and on behalf of our Visakhapatnam branch of SIRC for having